How are you? Good morning. Good morning to all. Can you hear me well? Please, we should start. Let me start welcoming Mark Carney and this wonderful panel, all the participants, the G30 members, and all our visitors. We are very happy to host G30 here. I'm happy to host it personally. I have participated in these meetings regularly in the past. I used to wear different hats: central banker, also as a private sector financial member, like some of you. Let me tell you that changing that hat and looking at this event from development perspective is not bad at all. I'm the good guy now. You should try it. I also want to share that I have always admired and respected this group and its work. Therefore, I'm happy to see all the panels and all of you here at the IDB. And the IDB and G30 have an history, institutional. This is not the first time that the IDB hosts this meeting. We are proud to have hosted in the past. We are deeply honored to do so again. I would like to extend an open invitation to continue hosting in the future. The G30's broad and eminent membership, from central banking to academia, make it an essential forum to discuss global challenges from multiple angles. In today's world, with growing fragmentation, polarization, geopolitical tensions, and uncertainty, dialogue, public debate is more vital than ever. We believe that the world today needs more spaces for dialogue to promote frank discussion, seek the global public goods, and help find the common spaces for consensus. These spaces, I must tell you, are scarce today. The G30 fosters this by bringing together diverse perspectives for shaping policies, strategies that address both current challenges and future opportunities. Let me tell you a little bit about the global context. We are in the midst of a pivotal global context, one shaped by uncertainties and shifts. Some factors I'm going to mention that you all know: low global growth, IMF forecasts around 3% growth going forward for several structural issues. This will stress economies that need to deal with high debts, that need to create jobs. Climate change, technological disruption, geopolitical fragmentation, all of these are important. The choices we will make now will probably make us decide whether the path is of cooperation or continue a trajectory of fragmentation. This bifurcation will probably be the most important decision we all make for the future. You are at the IDB. This is the house of Latin America and the Caribbean. Mi casa es su casa. So let me talk just 1 minute about Latin America. Latin America faces a triple challenge: increasing social demands, very small space, fiscal space and large debts, and low growth. And in addition, climate change and all the impact of that. We could talk here about all of these challenges all the time, but let me take the opportunity to say that there are always opportunities even within these challenges. And we believe that Latin America and Caribbean could be at an inflection point if the countries and the region seize the opportunity. And there are opportunities. Latin America is the place where clean energy could be exported and created. And that's very relevant for the challenge of climate change. Nature and biodiversity, not only the Amazon rainforest, other biomes. Food security. The region is the place we're 40% of the trade of food. What about supply chains? There are supply chains that could come from the region and be part of it. So we see an opportunity in this world, even this fragmented world, for Latin America and the Caribbean. And what is the role of the IDB? Is to be the bridge between the region to make this happen by connecting the region with the rest of the world, with global partners, financing and expertise. We can turn potential into progress. So let me just conclude by saying that both the IDB and G30 are important bridges to help build a more cooperative world. And I hope this seminar today is a building block in that direction. Thank you all for coming, and look forward for the important discussions ahead. Thank you very much.
Thank you very much, Alain, President Goldfan. You always were a good guy. It's even more evident now. And thank you for the IADB for this generous hospitality and for your not just thought leadership, but action leadership. Some of you may have noticed earlier this week, alongside President Jin, President Goldfan, and other heads of MDBs with the Brazilian government, launching the Brazil Investment Platform, which is a signature initiative across all aspects of economic reform in that country, and I think a lesson for the world. So thought leadership, action, great hospitality, good guy, good institution, great institution. On behalf of Jacob Frankel, Axel Weber, the Seche Kanyahu, the members of the G30, let me welcome you all to our 39th International Banking Seminar. It's great to see so many fellow central bankers, policymakers present and former, as well as members of the private sector and the media. This is a seminar that takes place against a backdrop really of immense structural change in the global economy, driven by geopolitics and technological change. Literally, our trading systems, our energy systems, even intelligence itself are being rewired. And there are changes coming and accelerating at the core of the financial system, including the nature, as we'll hear in the third panel, the nature of money and its implications. So policymakers face some pretty unique challenges. Prospect, it's a question, but it's prospect of structurally more volatile and potentially higher inflationary pressures, not higher inflation, because of course central bankers will deliver, but higher pressures occasioned by these structural changes, which bring a series of supply shocks. Fiscal pressures, starting from an adverse starting position, great calls on governments to support people during these changes. Adverse debt dynamics, lower growth, higher interest rates, and the challenge of productivity underneath it all, and then many calls through industrial policy and the motivations there. And then, as I thought the IMF did a great job as always, but one of the points that came across on the financial stability side this week, and our first speaker will have perspective on this, the gap that we see in the markets today between the level of uncertainty, the fundamental level of uncertainty, whether it's from geopolitics, the path of the economy, path of policy, and measured volatility and underlying risk premium. And how is that gap going to close? Is it going to close smoothly over time with a reduction of the underlying uncertainty? That would be nice. Or is it going to close sharply, as it often does in the past? And how robust is the system to that? I don't think we could imagine a better group of speakers to address these and other issues over the course of this morning. They only get 10 minutes, so they won't be able to address all of them, and we'll let them choose where they want to go. Our first panel is led by President Knot of the Dutch Central Bank, of course, chair of the Financial Stability Board, thought leader, action leader in the central banking community. President Jin of the Asian Infrastructure Bank will join afterwards, and Professor Jason Furman of Harvard University will provide his perspectives. The way these panels are all going to run is, in effect, I'm going to now get out of the way. I will have the best seat in the House. I will sit there. All I have to do is to keep time and make sure that we take as many of your questions as possible. So each speaker will take roughly 10 minutes. They can either speak from there or speak from the podium. And then we're going to open it up directly to your questions and then move our way through the agenda this morning. So thank you all for coming. And if I can start with you, Klaus. Thank you.
Thank you, Mark, and also thank you, Elaine, for the hospitality here in Washington, D.C. So what I will do is bring the euro area perspective to this panel on the global outlook. And I will do so under the title, Partly Cloudy Skies, but with a Silver Lining. And I'll come back to that. Okay, so if we begin looking at the global economic outlook, then it's clear that the latest PMI releases point to steady global growth. Weakness in manufacturing is compensated by strong growth in the services sector. But unfortunately, as you can see on the left-hand chart, the economic situation in the euro area is a little bit less favorable than the global average. And I would say that the current mood is a little bit like October weather in Amsterdam. It's not as bad as some people would have you believe, but it's definitely not great either. So economic growth in the euro area has been sluggish for 2 years now, and that you can see on the right-hand chart. And by the way, these are quarterly bars to avoid misunderstandings here. But nonetheless, domestic demand has been particularly weak. And initially, we could explain that quite well by falling real wages. But over the past 2 years, wages have largely been catching up with prices. And the short-term outlook is pointing to slow growth, while economic sentiment remains subdued. And the household savings rate is still higher than before the pandemic. And this is, I think, a thing that sets us aside, for instance, from the US. Looking further ahead, however, we do expect the economy to strengthen. Rising real wages will allow households to consume more, and the gradually fading effects of restrictive monetary policy will support consumption and investment. Now, in the euro area, there's always also the issue of heterogeneity. So zooming in on various member states, confidence is not low everywhere. Economic sentiment is significantly above the long-term average in countries like, for instance, Spain, Portugal, and Greece. The mood there is especially good in the services sector, which is benefiting from a reallocation of consumption from goods to services that took place after the pandemic. And this growth boost is particularly visible in tourism and hospitality. But also other sectors of the economy perform relatively well in those countries. But then there are other countries that are lagging behind, and that is mainly the case for Germany, where a combination of factors is weighing on the traditionally strong manufacturing sector. Energy-intensive manufacturing firms are still suffering from elevated energy prices. And moreover, the sector is faced with weak external demand, while domestic demand is not growing due to weak private consumption and even falling business investment. To me, the weak domestic growth in the euro area is slightly puzzling. Maybe the past high inflation, or maybe the political polarization, the geopolitical tension, maybe that is all weighing on consumers' moods. And of course, on the policy side, fiscal uncertainty may add to this picture, and a significant fiscal consolidation, for instance in France, will be necessary to bring public finances back on track and to reduce this uncertainty. Now, in line with the revised fiscal framework, the fiscal stance in the euro area is expected to tighten this year and also in the coming years, as energy and inflation support measures are gradually being phased out. Debt levels, however, are still expected to continue to increase, and that is particularly the case in the high debt countries. But that said, I'm a natural optimist, so let me get to the silver lining here. With macro indicators pointing to a soft landing, we do not foresee a recession in the euro area. And also, the financial sector is resilient. And inflation is getting close to target. So let me now focus on my daily bread and butter, inflation. Headline inflation in the euro area has come down to around 2%. The latest reading was 1.7% for September, confirming our assessment that the disinflationary process is well on track. Underlying, of course, there are differences between components. On the one hand, energy prices have pushed down the latest inflation reading, for instance, contributing to minus 0.6 percentage points to the low headline inflation number in September. But on the other hand, services inflation remains stubbornly close to 4%. And part of this strong services inflation is driven by growth in nominal wages, which are still catching up with past inflation. We expect these second round effects to dampen further in the course of next year. The GDP deflator, which is a sort of measure of domestic inflationary pressures, it has come down to 3.0 in the second quarter, from above 6% only 1 year earlier. And as you can see on the right, while unit profits were the largest contributors in the high inflation quarters, increasing unit labor costs are now driving the GDP deflator. And in absence of labor productivity growth, it is wages that determine most of the domestic inflation. So on inflation, it is clear that the risks surrounding the outlook have also become more balanced. In the short term, given the downward surprises to both headline and core inflation in Q3 of this year, we may see inflation dropping actually faster than expected. And this is also supported by further declining monthly dynamics of inflation and by declining goods price pressures. These charts here underline that also market participants now hold a balanced view regarding the risks to inflation. As you can see in this option implied distribution of inflation, the likelihood of inflation either below or above our target has become fairly even-handed. And this implies that for the coming 2 years, market-based inflation expectations are much more centered around the ECB's 2% symmetric inflation target. So coming from a period of prolonged setbacks and too high inflation, this is absolutely good news. Yet, at the same time, it is still too soon to declare total victory, as in the medium term, some upward risks remain. We still need to see a significant easing of wages, which is only expected in the course of 2025. And relatedly, we still need to see a cooling of services inflation for total inflation to durably return to 2%. On top of that, uncertainty remains significant, in particular on the supply side of the economy, as we are residing in an environment of heightened geopolitical risks. Hence, more adverse supply shocks hitting the euro area economy could pose renewed upside deviations from our inflation target. So, based on this assessment, the Governing Council last week took another step in removing what I would call the top level of policy restriction at its October meeting. Incoming data since our September meeting have strengthened our confidence that inflation will return to target in a timely manner. But also, the data point to increasing risk of disappointing growth in the near and medium term. And given that policy rates are still some distance away from the range of neutral rates, the decision to lower the deposit facility by 25 basis points is robust across a wide range of scenarios. Looking forward, in this environment with significant uncertainty about the supply side of the economy, it is important that we keep all options open. Retaining full optionality would act as a hedge against the materialization of risks in either direction to the growth and inflation outlook. On the one hand, policy restriction may be reduced more quickly if incoming data indicate a sustained acceleration in the speed of disinflation or a material shortfall in the economic recovery with its associated implications for the medium-term inflation outlook. On the other hand, policy restriction may be taken away more slowly should upside risks to inflation materialize or incoming data shed the opposite picture regarding growth and inflation. In any case, we believe that our meeting-by-meeting and data-dependent approach has served us well, as it helped to maintain the much-needed two-way optionality and the flexibility for future rate decisions. And on that rather positive note, let me stop here and give the floor back to you, Mark.
Almost see the sun through the clouds there in the Netherlands. President Jin, I give you the floor. Thank you.
Thank you, Mark. Good morning, ladies and gentlemen. It's really my great honor to be invited and address you. Our international banking seminar, and we focus on global economic outlook. I would say here we are all bankers. We MDBs, multilateral development banks, are different bankers, and maybe a little bit different from commercial bankers, but we're all bankers. We have the basic banking instinct to make money and to stand on firm financial basis. But of course, to be fair, multilateral development banks would have to look a little bit more about the development impact. And this does not mean that commercial bankers do not take care of the development impact. I know private sector companies are increasingly care about environment, social issues. This is very good. But there's one big difference. We, the bankers, are from the other businesses, because bankers do care about clients. We are not selling something like the private business people who buy something from us, and what happens to them, we don't care. But we do care about who we are doing business with. We do care about the quality, the creditworthiness of our clients. That is why we are very choosy and picky. Now, I'm going to discuss this issue from the perspective of developing countries, emerging market economies, to be exact. Because emerging market economies are the majority of the shareholders of our institution, Asian Infrastructure Investment Bank. To me, emerging market economies are the backbone of the global economy. They're just like the middle class of any individual economy. If the middle class is doing fine, the whole country is fine. No big problems. If the emerging market economy is doing fine, the global economy would be fine. So we focus very much on providing support to the emerging market shareholders of the multilateral development banks. And why should we lend to those emerging market economies who have access to capital market, who have access to the domestic resources? Why should we doing this to them? For one important reason. The rating companies will look at the quality of our assets. They give us triple rating, but they watch the quality of our assets. Only in so doing could we provide financing to low-rated, low-income countries. And let me tell you, in our bank, we have certain rules. The first, as everybody probably knows, being lean, clean, and green, right? Lean. It's important to avoid redundancy. Clean, anti-corruption. Green, we push for green economy. To ensure our institution or any other banks to do well, we have to take care of the risks. Not excessively risk averse, but risks are important. So in our Asian Infrastructure Investment Bank, we have the chief risk officer. And if the chief risk officer said no, I, as president, will not say, you have to do it. If the chief risk officer says no, it's no. So in our term, it's called a no, no to no. I will not say no to the no of the chief risk officer. So being lean, clean, green, and no, no to no, I think we'll be doing fine. And just because of this, we attach great importance to supporting the emerging market economies. We watch them to make sure whether we can do more for riskier countries, for poor countries, or to be a little bit more cautious. That is the basics we have to take care of. Now, IMF expects growth around 4.1% this year and next 5.5%. This difference, in my view, is very significant. There are a range of factors that are continue to depress the outlook for emerging market economies. From scarring suffered from the past shocks, weaker productivity, lower fiscal space, to increasing global uncertainty and geopolitical tensions. For emerging and developing economies, it means delayed convergence and serious development setbacks, and this is a reality. However, the outlook may not be as bad as it could have been. The global economy has shown extraordinary resilience in the past years, despite having been battered by multiple shocks. It seems that the so-called soft landing is within reach, meaning that disinflation is being achieved without major setbacks to growth, which is quite a remarkable accomplishment. And equally amazing is the way the global economy and particularly financial markets have shrugged off the unprecedented escalation in geopolitical tensions. There are certainly some problems. So the uncertainty is now structural. Structurally higher interest rates are also structurally higher, and the world is adjusting. So this is the world we are faced with. And I hope we will do our very best to support the emerging market economies to make it easier for them to sustain their growth, thereby a rising tide lifts all the boats. Please don't misunderstand me. I do not mean that developed countries are not important. They are. The problem is the economic weight of the developing and emerging market economies combined is getting more proportionately bigger. So if they do well, basically, the developed countries can also get the underpinning from the developing countries. There is something which really worries us. I'm looking at the debate or spats over trade. And as you know, recently there are some difficult issues without EVs exported to the European countries, US, and some other kind of things from developing countries. One big change we have seen over the last 4 or 5 decades is that the capacity or industrialization of EMEs, emerging market economies, and their capacity to manufacture goods is increasingly more competitive and challenging. So what do you see? I'm sorry to say that probably we are going from the free trade to a different kind of trade mode. I want to coin some terms, but I will not claim patent. It's called negotiated trade, contractual trade, or debate and argued trade. It's no longer free trade because you cannot rely on the WTO rules, and if you're free to develop your capacity for trade, and if you do that, and you find your exports encounter difficulties, you will be accused of building overcapacity. So it's really a very difficult issue, and that is also a warning to many economies in this world, EMEs, emerging market economies. If you expect a very good export market and building up your capacity, no matter how competitive you are, no matter how much benefit you can bring to your trade partners, you will have an overcapacity problem if free trade does not work. So we have to be very much careful about that. So what worries us even more is the barriers to trade in low carbon and renewable energy products, which are rising even more faster. Just when we need more of these green products to save the planet, their free flow is being restricted. And they end up being deployed to less effective users or not being deployed at all. So there's nothing short of a collective folly. The greening of global value chains should be an enormous opportunity for those less developed countries that are abundant in renewable resources to jump on the bandwagon, plug themselves into these emerging green supply chains, and sail to better prosperity. Now it appears that window of opportunity is closing down. It is imperative that we overcome these tensions and work together to combat climate change. Supply chain disruptions increase the cost of the green transition for all of us and hinder progress towards our collective goals. If the disruption of supply chain affects the consumer goods of our life, which is certainly a nuisance, but if this supply chain disruption would compromise our efforts to deal with the climate change, I think it's a really very serious issue. The problem is, do we, all of us in this world, really understand climate change is the most formidable threat to humanity? Do we all agree that climate change is really the clear and the present danger we have to deal with? If we do, I don't think we should have lots of debates, arguments about what should be done, what shouldn't be done. But I doubt it. I think still there are quite a lot of people who don't take this very seriously. And we will have to bear the consequences. May not this generation, maybe next generations, they have to bear the brunt of our negligence of this serious problem. So at this critical juncture, we multilateral institutions, the World Bank, EBRD, ADB, Inter-American Development Bank, our bank, we work together as a system. We try to push for more ambitious programs to help our countries on the right track to moving towards net zero. We need support. We need support from every quarter of the society, and we certainly would do our very best to make the best use of these resources. And this is what I said on many occasions. We must be clean. Now, on the one hand, we've been talking about increasing the lending to the low-income countries, which I think is a clarion call to all of the MDBs to do more. But I'm sorry to say that we have heard much less of the call to the effective use of development resources. We should make sure each and every cent goes to the right place, not find itself in the private pocket. You cannot simply increase the lending without highlighting the importance of anti-corruption, low efficiency, and with much, much less attention to where the money really goes or how the money is working. So I think it's very much important. We in AIIB are doing very best to make sure that we are lending to help these countries to grow, to improve the livelihood of their people, to empower the women, but not to feather the nests of certain of the people who misuse the resources. This is important for our reputation, but more importantly, for the health of global economy, for the common fight against climate change. So let me stop here, and I suppose you may have some questions, but I'd just like to draw your attention to this important issue. MDBs need to work together as a system, and we are working together as a system. We need your support. Thank you very much.
I'll give you the floor.
Great. Well, it's wonderful to be here with all of you. I'm planning to mostly talk about the U.S. macroeconomic outlook. I didn't have a title for my talk, but it will probably, appropriate title would be Sunny, but one should always worry about clouds. Before I get to that, I did want to just briefly say I very strongly agree with what President Jin said about the role of trade in addressing one of the greatest challenges that humanity has ever faced, which is climate change. And this is not a time at which we should be letting protectionism get in the way of the most efficient and cost-effective ways. The United States needs to use and produce a lot more solar power. We should buy those panels from the people that make them in the best and cheapest manner, and keep trade restrictions focused narrowly on legitimate national security concerns. So I very much agreed with what you said there, President Jin. On the U.S. macroeconomic outlook, the economy is growing at about a 3% rate. Moreover, recent data has made that 3% rate, the composition of it, look a lot better than it was before. For a while, it was the American consumer keeping the economy going, even while the Fed and higher interest rates was imposing serious restraint on the housing sector and business investment was lagging. But now we have housing investment starting to recover, and one of the strongest components of GDP has been business investment, driven in part by artificial intelligence, data centers, factory construction for microchips, and the like, all of which has some belief that it is going to be sustainable going forward in terms of growth. Moreover, consumer spending had been something that I personally was nervous about how long it could be sustained. But with data revisions, it turns out income was considerably higher than we thought. The saving rate was higher than we thought. And while consumers are still stretching themselves a little bit past what makes me comfortable, most measures like delinquencies and the like have risen, but are back to where they were prior to COVID. So they rose from very low levels to something more like a normal level. None of them look particularly dangerous or unsustainable right now. The labor market continues to be strong, with a 4.1% unemployment rate and adding about 175,000 jobs a month, more than 1 to 3 million jobs more than we expected to have from the vantage point prior to COVID. And the inflation rate has come down dramatically, and it's come down with very little increase in the unemployment rate, with a combination of anchored inflation expectations, a comparatively pleasant loosening of labor market as job openings fell without the unemployment rate rising very much, and then some favorable supply shocks. I should probably end here, but I have 6 more minutes, so let me talk about what I'm worried about. You should always be worried. So first of all, I think inflation continues to be more of a worry than recession. As good as any of us are at economic forecasting, if your economic forecast is whatever you've had over the last year is what you're going to have over the next year, that's usually even better. And the core inflation rate right now, core PCE inflation, is 2.6%. So, that's not a terrible forecast for the next year. And that's above where the Fed would like it to be. I do think there's some downward momentum in that. It has been falling. I think labor markets are on the loose side, so I had to bet. I would bet below 2.6 than above 2.6. But there's a number of reasons to be worried. Some of those are bottom-up reasons, like we're unlikely to continue to see goods prices falling. Some of the lower inflation a few months ago that was reassuring may have been quirks in the data that were the opposite of the quirks that temporarily elevated inflation at the beginning of the year. Some of the housing price slowdown may not happen in the way that people were hoping it would. And then from a top-down perspective, we have seen some increase in some measures of inflation expectations. Labor markets, while I believe they're on the loose side, you can read the data differently and argue that they're tight. And part of the disinflation we've seen has been good luck, and you don't expect good luck to last forever. And so I do think that remains a risk, not a certainty, but a risk. Recession is always a risk, and it's hard to improve on the forecast that at any point in time there's a 1 in 6 chance of recession over the next year. I can talk myself into being a little bit more nervous about that right now, given geopolitical events, given how long interest rates have been as high as they have, and the like. But then I also look at financial conditions which have eased, the equivalent of a 2 percentage point reduction in the Fed funds rate, the composition of GDP I referred to, the stabilization in the labor market, and I think I'm roughly at a baseline recession risk of 1 in 6. And this combination of greater inflation risk, normal recession risk, says that interest rates should continue to be restrictive, but they should be much less restrictive than they were because inflation is much less of a risk than it was. So it's appropriate to be lowering interest rates, just not too far and too fast, which is not something we've gone to yet. Over the medium and longer term, there are 3 macro issues I would point to. The first is that potential growth is very, very likely to slow from where it's been the last couple of years. In fact, potential probably was something like 3.5% over the last 2 or 3 years, and we were growing below it, as evidenced by the rising unemployment rate. I think that potential growth rate could easily slow from 3.5% to something like 1.5% to 2%. Why is that? Part of the recent high potential has been a bounce back of productivity growth from the negative that we saw before. It is possible that we'll go from that bounce back to a handoff to generative AI, predictive AI, and other forms of AI, adding to productivity growth. I think that's likely. I'm optimistic. But at the most optimistic end of the spectrum, I think it would add 0.5 point to growth and probably less than that. The more predictable thing, though, is much of U.S. growth has been fueled by a huge surge in immigration. And no matter what happens politically over the next week and a half, there will be much less immigration in the next several years. And so that part of extra high growth will go away. And so how is the economy going to adjust? Just to be clear, 1.5%, 2% growth, that would be fine. That's perfectly sustainable. That's perfectly good for an advanced economy like the United States. But how do we get from here to there is question number one. The second question over the medium and long term is where neutral interest rates are. The Fed has penciled in 2.8, but they talk like they don't believe that, and they think the number is higher. Financial markets have numbers closer to 3. I would probably myself join with most macroeconomists I know and pick a number higher than that rather than lower than that for a variety of reasons, including increased investment demand and the last topic I'm going to talk about, which is higher public debt. That neutral rate shouldn't matter a lot for near-term interest rate decisions by the Fed. By, I think, any measure, they're restrictive. By any measure, they can be less restrictive. But it does have an important implication for business investment, for where the Fed ends up, how much further they can cut rates next year, where I'm less sure about what's currently expected by the market and penciled in by the FOMC. And then finally, those interest rates have a very important impact on the last issue I'm going to talk about for the medium and long run, which is fiscal sustainability. The United States deficit last year was $1.8 trillion. That was 6.5% of GDP. The primary deficit, which excludes interest, is currently running about 3 or 3.5% of GDP. The only plans anyone in Washington has with respect to the deficit are ways to add to that. not to subtract to that. There are important differences in the magnitude with which different people want to add to that deficit, but the sign and direction is roughly the same for everyone. Looking at the difference between growth rates and interest rates going forward, I think we probably could run a primary deficit of about 0.5% of GDP, but that says a fiscal adjustment of about 3% of GDP is needed. I don't think that's necessarily an imminent problem. I think it means interest rates are a little bit higher, investment a little bit lower, but it's something the United States will have to deal with at some point. Otherwise, none of the growth that I've talked about will be sustainable or sustained. So I would conclude by saying things look very good right now. It's a little bit more likely that inflation stays high than that the United States goes into recession. Interest rates probably won't fall quite as much as people are expecting next year, unless I'm wrong about the recession part of that. And over the longer term, how do we adjust to slower potential growth? Do interest rates get stuck at a higher magnitude? And how do we make the adjustment in the deficit that eventually needs to happen? Thank you.
Brilliantly framed by all three of you. Lots of food for discussion. We have about half an hour for that discussion. So I'm going to look out in the darkness and look for hands raised and just ask, when you ask your question, if you could state your affiliation alongside. That would be helpful. So who wants to kick off? We're a shy group. It's unprecedented in the G30 history here. There, in the back. Yes, thank you.
Thank you very much. My name is Frank Vogel. I'm a professor at Georgetown University, and I am the founder of Transparency International. President Jin, it's wonderful seeing you here again. Thank you. I'd like to ask you to elaborate a bit on your concerns about trade, and in that regard also how it affects your efforts at clean lending. You see an enormous dislocation arising. If one of the candidates wins the US election, that dislocation could be far greater if we believe what he says. Perhaps you could comment on that and elaborate on the fears that you see. Thank you.
Should I?
Please, yeah.
Thank you, Frank. Nice to see you. And I instantly recognize you, which means you have not aged a single day since I saw you last time, more than 10 years ago. But thank you very much for writing the book about China's use of the IDA fund, and which is a very good book or summary of the developing country using the concession of funding to develop its economy. And I was in the World Bank in 1980. We are beneficiaries. We're the beneficiaries of IDA. By 2000, China became a contributor, graduated from IDA, and became a contributor to IDA in 2 or 3 or 4. If many emerging market economies could work like that, there's no short of IDA funds. Maybe there's no need of IDA funds at all. I'm dismayed to see this spat over trade. And free trade has brought huge benefit to so many countries since the end of the Second World War. Now, you may have noticed there's much less dispute among the emerging market economies as the dispute between developed and emerging market economies. I think the reason is not hard to fathom, because over the last 3 or 4 decades, the manufacturing capacity and industrialization process of so many developing countries have come to such a stage that they are increasingly competitive in consumer goods, even in sophisticated equipment. And this is the reality probably everybody have to live with. So I hope there would be a solution to put an end on this kind of endless trade dispute. because that is very much important. If the private sector is misguided, they may build up the capacity for export and end up being in a terrible situation of overcapacity. So I'm not saying that among developing countries there's no trade dispute, but compared with the developing countries, much less of a problem. I have no answer, but I do hope that all the parties concerned would do their very best to consider the realities of your trading partners and work out some kind of solutions. I have no answer, but I think it should be the focus of the discussions on trade. With regard to US election, everybody's watching, and I don't have a crystal ball to see what will be the outcome of the presidential campaign. And I think probably the trade issue between China and the United States, and maybe between China and some other countries, could be a very, very tough issue. Thank you.
Thank you very much, President. Piyush, and then I'll go in the back.
Hi, morning. Piyush Gupta from DBS Bank in Singapore. President Jin, my question's back to you. You described the emerging markets as relatively stable and likened them to the middle class of the global economy. That's interesting given the challenges the Chinese economy has been facing in the last couple of years, both the debt overhang in the property sector, as well as the headwinds coming from a lack of consumer confidence, savings rates are going up, and private investment. So what's your outlook for the Chinese economy and the consequence of that on your outlook for the global economy?
Yeah, I do think emerging market economies are the backbone of the global economy. And so not just China, but many other emerging market economies in Asia are playing an increasingly important role in stabilizing the global economy. I call these economies at the ballast of an ocean-going vessel. If they do all well, India, China, Indonesia, Thailand, all these Asian countries, Malaysia, if they can continue the growth momentum, I think it will be a big boost to the economies in the developed world. Chinese government has issued recently a series of measures to sustain the economy. And this time it's a little bit different from the measures they took in the wake of the 2008-2009 financial crisis. The fiscal policy is initiated to support the private businesses, but it's not flooding anymore. 2009 is flooding, right? It's now more focused. And the fiscal space in China is comfortable. So I noticed the Minister of Finance has been more proactive in providing more fiscal space and issue special bonds to help the local governments and the businesses. So it will take a little bit more time, but I'm confident that all these measures taken by the Chinese government will be effective. Thank you.
Okay, great. I'm going to take two questions, both in the back, one there and then one there, and I see the other hands as well. But
thanks very much, Beat Siegenthaler, Rocos Capital. I'd like to ask a question on inflation to both Jason and to Governor Knot. To Jason, in terms of the US and related to the elections, what is your assessment of the policies of kind of both candidates? Do you think they will, what impact they will have on inflation? Of course, on Trump, that kind of question is a bit more pertinent, as there is a lot of discussion how inflationary it would be. The market seems to be pushing in that direction. So I'm curious, what the extent, in your view, could be in terms of the inflation impact. And to Governor Knot, inflation in the euro area seems to have come down quite a bit faster than expected, and if I read the speech of Philip Lane, the speech economist of a couple of days ago, he seems to argue that really the underlying, or the threat of underlying inflation still being too high has pretty much disappeared. If that's the case, then why not to reduce rates quite a bit faster than it has been so far? Thank you.
Okay, so just hold those thoughts. We'll take the question, gentleman with the microphone there.
Hello, and thank you very much for your insights. I'm Brian Pascoe from the International Capital Market Association. A lot of talk about growing deficits, in particular in the US and Europe, a lot of which will be debt funded. I'm just wondering how worried is the panel about the capacity of the markets to absorb the debt and potential implications for financial stability? Thanks.
Okay, perfect. So I will concentrate that question in on both Jason and Klaus. Since US and Europe were mentioned specifically. Jason, here's the situation where tenure comes in handy. So what's going to happen, the implications of the US presidential, and just don't hold back. Just tell us what you really think.
Don't hold back. So with Harris, it's quite simple. There's basically no macro impact on anything because she's largely continuing the same policies we've seen. And if anything, it's less of the same, not more of the same, because of political constraints. A moment for large stuff has passed, et cetera. Trump is an enormous amount of uncertainty. There is one possibility that I think is a very distinct one and has a decent chance of happening, which is that he is focused on the stock market. The stock market on some things gives you immediate feedback about what it thinks about what you're doing. Now, there's all sorts of things I care about related to things that aren't economic that the stock market gives you no feedback on and places no constraint on. But 20% across the board tariffs, actually spending $7.5 trillion as promised, expelling 10 or more million people from the country. I think there are a set of constraints that could stop that. But I say could, there's an enormous risk there. And when I say a risk, I don't think it's 0.2%, and I don't think it's 2%. I think it's higher than either of those numbers, that when somebody campaigns on something, when they seem to truly believe it, because they've been saying it for decades, it's what happens. And almost all of that is inflationary. The tariffs are, the larger fiscal expansion is, and insofar as he was able to do anything about the Fed, which I think is hard to do in 4 years, but something that you could very easily accomplish in 8 if 2 presidents in a row put their minds to it. All of those only go in one direction. So again, that's a risk. That's some probability. That's, maybe call it 20% multiplied by the consequences of it. And that would lead me to add, I don't know, 0.4% to my inflation forecast, but also much more to the risk around that forecast. In terms of the debt, there's the known knowns of the debt, which is for each percentage point of debt, maybe interest rates are 1 to 5 basis points higher. And so each year the debt goes higher. Each year there's a bit of upward pressure on interest rates. Each year investment's a little bit slower and more crowded out as a result of it. And that's where I think the bulk of the probability is. And then there's the unknown part, and the unknown part is unknown because, Brazil had a crisis, massive one, Brazil, Argentina, at debt of 45% of GDP. Great Britain had no problem a century and a half ago borrowing 250% of GDP. So we really don't know where that broader threshold is. It depends a lot on what the borrowing is for, what the prospects look going forward. I guess I'm decently skeptical about it, and I'd put almost all of my weight on higher deficits having a basically linear effect that drive up interest rates, but not some type of nonlinear market functioning one. But I'd also say I'd rather not find out the answer to that by running an experiment in the United States. There's other countries that could do that experiment instead.
That's very well framed. Okay, what about the other countries?
I don't know if the Netherlands is going to do it.
Well, maybe not the Netherlands, but there's some of your neighbors are running this experiment. Are they going to find out?
Okay, but I take it you want me to respond
yes,
to
both
the
the inflation.
Yeah, okay. Yeah. Well, first of all, on the inflation, it has come down recently quicker than we thought, and we will have to update our inflation assessment at the next projection meeting in December. So the cut we made was at a non-projection meeting. So we already anticipated that at the next meeting we will also probably bring forward the path toward 2%. and then have to reevaluate also the path of interest rates against that background. Why don't I think that we should have brought rates down more quickly? That has everything to do with the labor market also in the euro area. If you look at wages, they are still running at roughly double the rate that is compatible with a 2% inflation target and let's say the 0.5% productivity growth that we enjoy in the euro area. And so for us to sustainably return to 2%, we would need to see quite some decline in wages. It is there in our projections, that decline in wages. And so far, our projections have also been quite accurate in predicting the path of decline in wages. But this was the easy part. The biggest declines in wages are still ahead of us and need to take place, let's say, in the first half of next year. And I would just need to see a little bit more conviction that that is actually also happening according to plan, because the labor market continues to be tight. The labor market is not all that dissimilar in the euro area from the US, unfortunately at different levels of unemployment. But also in our case, we basically have full employment at a higher level of unemployment, but that's structural factors. We have the number of vacancies coming down without unemployment going up. So there is still ample tensions in the labor market. And that's why there's some beginning of, let's say, talk about us undershooting our inflation target again. And let's be very clear about it. I also mentioned that in my speech. We have a symmetric target. Let there be no doubt about it. But of course, we would only have to respond if we think that there is a structural undershoot of the target. I was around in the 2010s when we had structural undershoots of our inflation target. And by then, I can assure you that the wages and the wage growth and the labor market we were looking at was an entirely different labor market than today's labor market. So that's why I'm not so much... The downside risks to growth that I see are risks of a recovery in consumption not taking place, being delayed. It's not a downside risk in the direction of a severe recession, a severe deterioration of labor market conditions, which would then also bring down inflation a lot faster. But we will know a lot more in December. The market clearly has brought forward the rate path quite dramatically after the September numbers on PMI and also the consumption numbers. We will have to see whether that was a little bit over-enthusiastic or not. We will only know once we do our own calculations again in December. Now, on the capacity of markets to absorb the public debt, so far so good. I mean, we have already seen a massive shrinkage, massive contraction of our balance sheet through the repayment of the TLTROs. A lot of these TLTROs were actually used for carry trades, so that could have had an impact on bond markets. We have started the QT on the APP. It's well in train. On the PAPP, the Pandemic Emergency Purchase Program, we're now sort of doing 50% QT, and as of January 1st, full QT. This has all not have any impact so far on bond markets, but this is of course something that we will have to closely monitor. We have a new operational framework within which we are quite comfortable that we can deal with such tensions and make sure that we have the liquidity providing measures at least to the banking system if such tensions due to the bank sovereign nexus were to arise.
Fantastic. Well summarized. Okay, we've got time for a few more questions. There were a few more hands up previously. We'll go to Laura first. Laura Tyson, please. Just in the front row. Yep, it's coming up behind. And then...
I noticed, can you hear me? This is really about the overcapacity industrial policy arguments. I noticed that the Draghi report was not mentioned at all. I noted from Jason the continuation, I would say, of industrial policy, the IRA industrial policy, the CHIPS industrial policy would likely continue under Harris with additional protection under Trump. So I'm just interested, Draghi, any reaction to that. And then related to trade, if there is this industrial policy that is going to go on, why not, and I think Europe is doing some of this, just invite the producers to produce in Europe, to have the producers produce in the US. So the role of foreign direct investment as a substitute for changing supply chains.
Yeah. Okay, so Draghi, discuss. Of course, Mario is always with us and embedded in everything. I'm going to start with you, Klaus, on that, because, of course, one of the things you mentioned was this, that Europe, and I wrote it down, enjoys 0.5% productivity growth. Does Europe really enjoy 0.5%?
No, that was of course an ironic
It was
choice.
an ironic choice, yes.
Choice of words.
So
we also know, by the way, that if we do manage to get policies in place to positively affect productivity, it'll take a while.
Yeah.
So don't expect any
Exactly.
miracles. So for the medium-term outlook that I'm looking at as a central banker, I think we can safely make our calculations with these kinds of low productivity numbers. But of course, as Europe, we should not be satisfied with this kind of, let's say, mediocre productivity growth. Also, because the aging is going to hit us even harder than in the US, that the attitudes toward immigration are probably even more ferocious in Europe than they are in the US. So productivity growth is really going to be the only game in town, if I may use that word, in terms of creating potential growth for us. So I think the Draghi report and also the Letta report are extremely welcome. I take it that the main message from the Draghi report is that in Europe there are many economic activities, many markets, transactions, etc., that we still too much look at from a domestic perspective, but that rather we should take a much more European lens toward these activities. And I mean, the concrete examples he gives is defense, is energy markets, capital markets, etc. And I could not agree more. I think there is still, we are not exploiting the full potential of the internal market. There is some internal markets of goods. There is no internal markets of services. I think there is still lots and lots to be improved over there. And then, of course, there is the financing question. That's a more touchy question, so I have to be careful in a country where I come from. But here my attitude is very simple. If in step one we do agree with this analysis, and we do agree that actually we should do more at the European level, then of course we also have to face the question how we're going to finance these activities at the European level. I mean, that's a logical, inescapable question. And I will also say that the current model in which we finance European expenditure through national budgets and then having national politicians go to Brussels fighting about the budget, and then national politicians having to explain to their voters why the taxes are being levied that are spent in Brussels, that has vulnerabilities. It has the vulnerability that the political accountability is not in the right place where it should be. The successes of Europe are not being celebrated by national politicians because they don't get elected by European successes. They only get elected by national successes. But Europe is a cost factor for them. It's only a cost center because it's only something out of the budget that they have to pay into another budget. So in the national debates, you get too much emphasis on the cost and too little emphasis on the successes of Europe. Now, in the UK, we know what the end point of that situation has been. I am not saying that any such movement is there on the continent yet, luckily so, but I do think it's a structural vulnerability. So yes, if we do more stuff, if we think that there are more public goods that we can provide more effectively and more efficiently at the European level, then at some point we should also think about sort of financing instruments that have a slightly more European character.
Excellent. President Jin, I might take one aspect of Laura's question direct to you on the foreign direct investment as a substitute for trade. So given the outlook, do you see that as part of the potential response here?
I know certain companies try to avoid the trade disputes and to move their plants to Europe or United States so that the origin of products could be different. I have yet to do some really detailed research into this, but my general impression is it could help but not that much. You know why? Because the labor cost is a very important component. So when you move a plant to the United States, you'll find an otherwise competitive company is not doing very well. And this has already examples such as chips, you know. And unless they can solve this labor cost, probably use more robots. Okay. I hope the robots' wages would be the same across the world. I hope so. Then we have put an end to all this kind of
benefits
disputes.
in Europe.
There were some Chinese companies who, I think I remember many years ago, not EV cars, the glass, floating glass. They opened, I think they established plants in some of the Midwest of the states. And then they find it's not working. It's not working. For the Chinese workers, you pay, they work. And you tell them, can you come here over the weekend? You pay, I will be here. Extra hour, no problem. But you see, in the European countries, there's very strict rules, 8 hours down the tools, they go. Now, how can you do that? You pay them more, they would even be working less because they can make more, you know. So I think it's very difficult. Maybe you pay them more for overtime for a couple of weeks, they think it's fine. But later on, they have sufficient money to be enjoying themselves on the beaches, you see.
Very good. Okay. Jason, you're in the heartland of industrial policy in America now.
So I thought the Draghi report was terrific. I have a piece about it in Le Monde you could read. I don't understand a word of my piece, but maybe French, or can use Google Translate. And you know, in AI especially, scale is what matters, and that's why China can do it. That's why the United States can do it, and that's why 27 countries in Europe can't do it. And they need to figure out how to get that scale that we have. On FDI, I do think this is going to be where there's a difference between the United States and Europe on EVs. Both of us put tariffs on Chinese EVs. I think their end game is to get some Chinese plants in Europe. I think our end game is to have an incredibly costly and inefficient EV industry for the indefinite future. And the United States just can't be so arrogant to think that we don't have a lot to learn from a country that is much better at making EVs than we are. For a very long time, we were better at most everything. We didn't have anything to learn from China. That is not at all true today, and an economic policy that's based on denying that reality is going to be quite a problem. On the labor costs, I would distinguish between something like microchips, which are a national security issue. And so our microchips are going to be more costly and more inefficient to make in the United States, and we should absolutely do that anyway. We shouldn't be getting 90% of the advanced microchips from one island. EVs, I think, are much less of a national security issue, although not all the way to solar panels. But I do think there's a lot of efficiencies that we can make up for higher labor costs with.
Fantastic. If somebody has a very pithy final question and a short name.
There's somebody
for the
rather-
There's somebody waving. Mark.
Somebody's
somebody
upstairs
waving.
Oh, somebody waving upstairs. Okay,
Yeah,
sir, with
there's
a
no
very
line.
short question.
Thanks. We're in the press gallery up here. We're a little bit out of your line of vision.
Time's up.
But President Jin, just to go back to what you said about your confidence in the effectiveness of the Chinese government's economic stimulus package, can you please be a bit more specific? Where is the confidence coming from? And do you have any policy guidance? Because a lot of the conversations that we had this week, there's a lot of uncertainty about the details. So I would love to hear, where's your confidence coming from? Thank you.
And just remind us of your name quickly, sorry. That's all right. Colin. Okay.
You see, you can take a look at the series of measures which Chinese government has initiated or re-emphasized. But one thing I notice is that it's very important to promote the enabling environment for the private sector, for small and medium-sized enterprises. So to make their life easy to do their business and create jobs, and I think it will take a little bit more time, but I just like to say there were so many people who predicted about the Chinese economy, and 99% of these forecast predictions turned out to be wrong.
Yeah. Yep. Under predicted, I think, in one direction. Fantastic discussion. Jason or Klaus, do you have any last pearls of wisdom? I'll just check. I mean, you have many, but
None leading to mind.
none that you want to. Okay.
No, I
Klaus,
would just
anything
say
that
what Jason said about
Yeah.
China and electric vehicles. I think that's very much true for Europe as well. So I think if there is a trade war or something of that kind on the horizon, we stand to lose a lot, I think, within Europe. So I think I think we better look also a little bit more friendly to both West and East.
I think fantastic discussion. I think I couldn't try to summarize, but I'll make one point, which is the focus, as will be in the next panel, is an element of the current economic outlook. And the panelists, I thought, did a fantastic job on that. But it is inevitable in talking about the current economic outlook that these structural issues and the rate with which trade policy is changing, industrial policy is changing, the geopolitical overlay, and how it's being brought back in. And I'll just note, as Laura and others will know, and readers of Le Monde will be aware, a couple of points that were in Mario Draghi's report. One, and Jason alluded to this, the scale of the investment required in the European Union for the digital transformation and the green transition, he pegs it at 2 Marshall Plans, around 5 percentage points of GDP of additional investment year in, year out for decades. Anything approximating that, and it's something similar in all our economies, I think equilibrium interest rates, that biases them a little higher, certainly, all else being equal. That's an obvious point. And the second point, he really emphasizes this issue around, and I'll use his term, the old paradigm, maybe of globalization, is fading. A rules-based order is fading. Yep. We don't yet have the new one in place. I think it's incumbent on all of us to help construct a new one that is going to work for people, not just for political sound bites in the very short term. So with that, join me in thanking the panel, and we'll do a quick switch over to the next.
Thank you.
Okay.
Thank you.
But I do think.
Just take 1 minute to switch over. Hopefully water for our guests, our panelists. Great, thank you. Fantastic, Mr. Governor. We have Governor Lasecha. So welcome back. We're bang on schedule. Following up on that excellent discussion on the global economy and some of the aspects of the new international economy, not defined, but I think the panel will probably help us define it in terms of their own selections of their priorities. I am going to go straight into it. We're joined by our host, President Goldfan, Governor Kanyahu of the Reserve Bank of South Africa, incoming president of the G20. And we all know that the central banks really run the G20 when they're, no, just kidding. We're there in a supportive capacity, of course. And Governor Gafoor, thank you for joining us from Malaysia. So I look forward to this. And again, same rules of the game, roughly 10 minutes of comments. You can do it from your seats, you can do it from the podium. And then we'll open it up to questions. I'll do my best to catch everyone's eye and include as many as possible. So Ilan, please.
Thank you, Mark. I'm going to do it from here. I already had my podium experience
Podium
today,
moment,
so
yep.
I'm going to start here. So it's a pleasure to be with my friends here and this distinguished panel. This discussion about the economic prospects in the new international economy, as I mentioned at the beginning, we are in the midst of a pivotal global context, one that is shaped by a lot of uncertainties and shifts. And let me mention a few factors that I believe are very important. One, climate change. This is really changing the context, and we have been working with Mark, with others. Countries are facing increasingly the costs of climate change, and this really is changing the way countries, small islands, smaller economies, larger economies, they're all into the consequences of climate change and how they're going to deal with it. Second, technological disruptions. Everybody's thinking about AI, digital. How do you prepare for the future in terms of technology? Third, fragmentation. And for me, fragmentation is the most important factor when we look at forecast of what is this scenario going to have. If we are able to bring back this trend of more protectionism, more tension, more division, into one that we go back to a world of more consensus, of working a little bit more together, that will change significantly the scenarios we go ahead. Latin America and the Caribbean. When we look at the data, we are seeing data that is similar that we're seeing other places. Growth, surprising to the upside. Every time I talk to my research department, they say, well, surprise us, but this year is going to be different. And yet again, so for example, I'm going to give you the largest country, Brazil. For the third year in a row, the 2% growth forecast became 3% growth. What's happening? Inflation went down quite a bit. From 9.8 was the peak in 2022, 4.4 in July. Is it going down as fast as central banks would like? No. But they had this decisive and very important actions at the beginning. Fiscal pressures are there. That's also not different from the rest of the world. A lot of debt, a lot of fiscal constraints. Now, where are the opportunities? And I mentioned a little bit at the beginning. Latin America has a key role, I believe, in several of these issues that I mentioned. First, in terms of climate change, this is a place where Latin America and the Caribbean can actually offer part of the solution. And we should not sell this issue as a problem, as you have to pay for it. You need to sell it as this is the job-creating mechanism. If you are embarked in the transition, you're embarking in a very important force of creating jobs and growth. And that is the way we can, because if we go about, we have a problem, who's going to pay it? Is the global north, the global south? This is not the dialogue. The dialogue is, there is an opportunity, there is a challenge, here is how we can make a challenge into a job-creating opportunity. And that has been very important in our dialogue with the countries. So when we talk to Chile and they have an agreement with Germany, we say, we're going to help you have a green hydrogen sector. When we go to Brazil and they have this transformation model, we talk to them about it, and so forth and so on. So that's a very important role. The second role is we are in a fragmented world. Can we help to integrate at least the part of the world that can be integrated? So we are working very hard in terms of integration with the Americas. We have studies about supply chains, and we chose 3 areas: medical supplies, also we have climate, we are going to talk about infrastructure. There's several areas that we have chosen where we can see where it can fit with the Americas, but also with Europe. Europe have the global gateway. There are a lot of projects. We have been engaging with them. So challenges could be part of the solution for this part of the world. So let me just close by saying it's always difficult to think about the future, but I think we have a few important elements. Of the most important global elements, fragmentation versus cooperation. This will be the main determinant of where we're going. In terms of Latin America, I actually see all the challenges as an opportunity. And I believe that we can work with that. So let me stop here and let others have their initial remarks.
That's fantastic. Thank you. I'm going to go to the other panelists, and I'm going to come back to you because you've saved a tiny bit of time, but I'll come back at the end and just ask, within this context, in terms of financing and financing flows and the role that, just blending in the core role of the IADB for that, if I may. But Lesetja, may I give you the floor, please?
Thank you, Mark. Spent the past 2 days being subjected to a 2-minute rule, so I will not use the full 10 minutes.
Take the full time.
So
You have a 10-minute rule.
There was never a 2-minute rule when I was. Yeah.
Well, central bankers are very careful with language, so we don't talk about wars, we talk about geopolitical tension, challenges. Whatever we call them, these challenges have intensified markedly. The wars in Ukraine and the Middle East are getting most of the attention and have generated the most severe global spillovers. But we should not forget the disasters in the Sudan, the problem in the Sahel region of the African continent, and other areas of serious instability such as Myanmar. The world is also on fire in another sense. Climate change is a reality. And for us on the African continent, it's not a debate about whether it is here or not. We are living through it. We are living through natural disasters, and it makes planning for the future very difficult. Give you an example, in South Africa last year, we had parts of the country that experienced serious drought, and at the same time, had parts of the countries that experienced the worst floods ever. And it's a nightmare for planners. What do they plan for? Drought, or do they plan for floods? So intellectually, we have all known about the seriousness of the climate change challenge for some time. But knowledge is becoming more visceral now, as we were reminded by the recent Florida hurricanes, Helene and Milton. The climate crisis is no longer coming. It is here. We also have some severe macroeconomic problems. Clearly, there is a fragmentation trend in the global economy. There are risks of escalating trade wars, or as a central banker, I should say, trade tensions. There has been astonishing growth in sovereign debt, and it is not clear how we recover fiscal sustainability. Let me take the first issue of trade policy. We're getting into a world where more and more areas are being declared strategic, which justifies locking out foreigners. And not only do countries want to lock out foreigners, they also want to promote their national champions, either champion companies or whole champion industries. And this is not just about tariffs. It also entails generous subsidies of one form or another. And this brings a terrible dynamic to the global economy, a game of chicken where we compete to see who is willing to throw the most resources at their champions. Countries with limited resources, which include many emerging markets, are the first losers. You cannot compete on subsidies. You don't have the fiscal space. You probably don't have the state capacity to assign funds productively either. But even countries with more resources should be scared by this development because it forces you to place big, risky bets for fear that if you don't, someone else will outbid you and you will have to leave the table. So the incentives drive those who can to take more risks, and they drive the rest of us off the road. Second issue, which has to do with the problem of debt. Here I am concerned about the best eras of global policy making we have. You know, the question of debt getting into the current juncture. The natural response to the COVID pandemic was for the central banks to provide monetary stimulus and for the treasuries to provide fiscal stimulus. And they did. But what the treasuries actually did, and the mantra was a simple one, the response has got to be temporary, it has got to be targeted, it's got to be time-bound. Except temporary is still very much with us, as treasury after treasury tried to justify why the measures that were taken in the middle of the pandemic should be kept in place a little bit longer, and they get renamed. So we had in South Africa a loan guarantee scheme to keep credit flowing during the pandemic. And once the world was opening up, the loan guarantee scheme was renamed a business restart scheme. Before we knew it, it was called an energy transition scheme, and it was still the same thing. And bottom line is, the treasuries didn't want to let go what was supposed to be war-era measures. Well, they could do this. There was access to fairly cheap money, but they binged on the debt, and this was to catch up with us, because then what we ended up having then was that debt is rising, and there doesn't seem to be an end in sight. And the IMF talks about rebuilding buffers. But for many low-income countries, there isn't even a question about building buffers. It's to try and restore fiscal sanity, otherwise known as fiscal sustainability. But that is what we face. So, in the best eras of global policy making, we have a positive sum game here where there is openness and living standards rise. In the West era, we play a negative sum game where output stagnates or falls, and you measure your success by whether other people are hating more than you. As Bretton Woods showed, going back to the good equilibrium is very hard. It takes a lot of coordination and courage, and it may well take a major crisis to catalyze change. At this moment, I don't see how we reverse the direction of travel, but diagnosing the problem correctly and building awareness seems like a good place to start.
Fantastic. Okay. We'll look forward to that major crisis that brings solutions forward. All right, Governor Gafoor, and welcome.
Thank you. Morning, Makani. Morning, everyone. Thank you for having me speak here today. Allow me to share perspective from Malaysia as a small and open economy, and particularly from the ASEAN region. If you look at the topic, new international economy, I believe it's characterized by many contending forces. But for today, I would like to focus on three important mega trends. I think some of it has been mentioned by various previous speakers. One is geopolitics, second in terms of trade fragmentation, and a third in terms of transition to a green economy. And this will come from the emerging Asia perspective. On geopolitics, have seen intensified geopolitical competition among great powers has actually weakened the rules-based international order. A couple of points on this. First is that we have seen for 2 decades, starting from the 90s, multilateral institutions provided emerging markets and developing in countries with structures and mechanisms by which to engage the global order and pursue shared prosperity objectives. As a result, globalization and multilateralism have significantly contributed to global trade and investments, and this has led to widespread benefits across all economies, including the developing economies. However, today, this multilateralism is severely weakened and replaced by a cascade of unilateral measures that often ignore the global good. Therefore, emerging market economies now must adapt to this rapidly changing landscape. Southeast Asia, for example, is a pivotal connector region, has become more crucial in global affairs. ASEAN neutrality has made it well positioned to maintain and expand linkages between competing blocs, thereby providing a stabilizing force during these fractured times. To mitigate geopolitical impacts, businesses have rerouted trade to Southeast Asian countries, bringing resilience to global trade. Therefore, regional groupings of EMEs such as ASEAN possess expanded scope for coordinated actions in shaping a more just and equitable global order. The competitive spirit among EMEs should be complemented, where feasible, by the pursuit of shared interests when dealing with larger global actors. And concurrently, multilateral institutions must persist in advocating for restraint against enforcing policies that could restrict trade and investment, in order to prevent the potential regression of benefits derived from economic integration. Let me touch on the second point on the trade fragmentation. In the new international economy, trade is increasingly fragmented and supply chains have been reoriented. And this has led to shifting developmental and trade strategies among the EMEs. We have seen the COVID-19 pandemic and the aforementioned geopolitical factors. This has shifted the focus from efficiency more to resilience, from just-in-time to just-in-case production strategies. EMEs are increasingly focused on enhancing reliability and resilience in supply chain, while maximizing their comparative advantage by leveraging on new innovations and upgrading their industries towards technological frontier. We also observe the integration of new industries into emerging markets. The ASEAN region, for example, is witnessing an influx of digital investments, and regional actors have the opportunity to harness these investments to create indigenous firms with the potential to both grow and shape the digital economy at a global level. The emergence of financial innovations such as local currency settlement and ongoing collaborative efforts to enhance the efficiency of cross-border payments will certainly further empower the EMEs in global value chains. For example, within ASEAN, the increased regional trade and tourism have actually accelerated multilateral efforts, such as one good example is the one that we are working together with the PIS Innovation Hub, is the Project Nexus, which aims for instant and efficient cross-border payments. From a global perspective, exploratory CBDC projects such as the Project Dunbar and mBridge hold great potential to enhance cross-border payments efficiency as well as facilitate trade and investment. My final point is on green transition. In this regard, ASEAN has placed sustainability as one of the central themes. As part of the upcoming ASEAN Chairmanship, Malaysia has placed sustainability as one of the central themes, and the ASEAN strategy for carbon neutrality seeks to establish 4 key outcomes for the region. First is in terms of the development of green industries itself. Second is interoperability within ASEAN to accelerate rollout of green technologies. Third, ensuring ASEAN remains a top destination for international capital. And fourth, the development of green capabilities. We are acutely aware that achieving these goals will not be simple and easy. Southeast Asia faces a sizable investment shortfall of more than $100 billion per year to achieve its green infrastructure goals. Therefore, innovative financing mechanisms will certainly be crucial in facilitating the transition. And this will include, among others, first, by deploying blended financing solutions to attract a wider range of investors and cater to a diverse set of funding requirements in the region. Second is the participation of multilateral development banks and international financial institutions to alter the risk-return profile of the climate transition in emerging economies. Third is expanding the use of green sukuk to finance a wider range of sectors beyond just renewable energy and green real estate. And fourth, establishing a regional greening value chain program. We have done this in Malaysia, but I would like to expand this to the region. And this is to support the SME's green transition, including providing financial, technical assistance, and exchange of knowledge. Nonetheless, EMEs will need to be equipped with the right technology, skill sets, and also know-how for us to be able to play their role towards ensuring environmental sustainability. Here, I would like to take this opportunity to invite the international community to support these initiatives and partner with ASEAN as we collectively strive to achieve the Paris Agreement goals. In closing, a shared prosperity framework to create an equitable and sustainable growth for all should be a priority in a currently fragmented world. The rapid growth of EMEs towards the global frontier in a manner that increases the complexity of their economies could create significant new sources of shared prosperity. And this includes substantial spillover benefits for advanced economies, like expanding markets and global demand, driving innovation, enhancing resilience, and creating a more sustainable future. There should be credible commitments and actions at a global level to ensure that climate adaptation and mitigation needs of all are met through sufficient financing and technical expertise. I believe the world can draw valuable lessons from what we have seen in ASEAN's approach, where we embrace a consultative, gradual path to setting standards, fostering integration, and creating solutions that benefit everyone in this new global economy. Therefore, I believe we can build the future of shared prosperity. Thank you.
Thank you very much. Excellent. So 3 excellent set of framing remarks, and I'm going to open it up to the group for questions, so get ready. But Ilan, I want to just ask you, and actually ultimately would be a question for all the panel, but we'll let others frame it. But just in terms of, we've seen this fragmentation. Well, one can call it fragmentation and can also call it a reordering of trade flows and tensions. Yeah, we call it tensions. Covers many things. Yeah, I remember in the financial crisis, it began as tensions. I think Jean-Claude had it as turbulences, and then it became tensions. And then it was actually at a G30 meeting in the fall of 2008, and people were talking about the crisis. And he was like, I thought it was turbulences. Who's admitting that it's a crisis now? It really was a crisis. So when you get to saying it's a crisis, it's a crisis. But so we have these tensions in trade, the reorienting of trade. And my question is, what you're seeing from the IADB in terms of reorientation of capital flows and the role that you play in ensuring that the capital is there for the underlying investment.
So it is very clear the gap that exists globally to do whatever all of us need to do, both in climate finance, but also in terms of poverty and food insecurity and all of that. And it is clear that the public sector resources are not enough, both from the donors' country. Budgets are very tight, and issues about whether you have Ukraine war, you have others, but also from the point of view of the budgets of the receiving countries, because they're indebted. So public sector has been quite difficult. We are doing our best. The capital adequacy framework is there. The IDB, for example, have just been able to increase by $5 billion on top of what we do every year, just from savings and that. We, as a group, MDBs, have just published that we will save $400 billion over the 10 years. But that's not enough. We need, of course, private sector mobilization, which I understand basically not as only wealth creation and allocation, but really reallocation of existing resources towards there. That's the magic here. And we have been working together on how do we do it. Financial innovation or attracting. From the point of view of what we do in the development banks, the number 1 and 2 and 3 that private sector investor ask us is just put in order what we cannot control. What does it mean? I cannot have a regulation that changes every 2 or 3 years. I cannot have a place where rule of law does not exist. I cannot have a place where volatility in the currency is so large that whatever I do with my own project is there. I frame it by the difference between risk and uncertainty. They know how to deal with the risk. Uncertainty is where they cannot actually calculate it. And this is where I think the contribution of the public sector is. More than the money is that. And I think the capital flows issues that you mentioned, the fragmentation, will come back if we are able to deal with this part, in addition to the innovation, financial innovation we are doing. I'm just going to end with some of the financial innovations that we are working together. We need to mobilize private resources. So we are embarking on models like the original to distribute, original to share, which is basically you originate the projects because you have local presence and you know what are the projects, you help create the projects, they are there, you have the convening power to bring resources with you, but you don't stay with the project on your balance sheet for long. Maybe for some time, but not forever. And we just had a deal this week with Santander, where we stay We sold, at the IDB Invest, we sold 95% of our portfolio. It was not the whole portfolio. We started with $1 billion, which for the IDB Invest is quite large. And that was important for several reasons. One is that was, for us, a beginning. It was successful. We were able to reach a pocket of investors that we never did before. Private insurance, longer-term pensions, because it was more diversified. From our point of view, we freed capital, and we can start again to do it. So that's an innovation. The other innovations like debt swaps and resilient clauses in debts or sustainability bonds, which basically you give money, and if the country achieves its targets, you give a discount. The discounts come from grants. So there are a lot of things that we are thinking that are helping, but that's just part of it. I think the large part is policies, putting the house in order, being able to attract the private sector. So sorry about the long digression on that.
Well, no, it was a big question. It was a big question, deserved a big answer. Okay, so we'll open up the floor, and I'm going to start with, in the front row with Jacob Frankel, please. You can get a microphone to Jacob. And then, sorry, then there's a gentleman behind. Jake, yeah, right there. It'll come on when it seems to.
Well, thank you very much. I would like to connect a little bit in my question the two sessions. In the first session, the impression was relatively sanguine, I would say. The question was whether 0.5 is mediocre or can enjoy it. And everyone looked at it was really positive. And then came the wake-up call from Lesecha saying, come on, well, there are wars in the world. And he reminded us about the Middle East, Ukraine, etc. And in the corridor before, the things, I took some notes. They said, what are the issues? Tariffs, trade, climate, fiscal sustainability, North Korea, Taiwan. Reminded us that last year here, Nigel Ferguson spoke about the vulnerability of the world to the TSMC, the semiconductor. It looks much more of a drama than what came in the first session. And now there are four governors here, or former, once a governor, always a governor.
Thank you.
There are four governors here. And what is common to all the things that I mentioned? They have nothing to do with monetary policy. They did not arise from monetary policy, nor will they be solved in monetary policy. And yet, everyone looks at the only game in town. The financial stability maybe is relevant here, but it's not a sine qua non. And I thought that the remarks by in the morning about we can really deal with the debt in a relatively easy way were a bit too sanguine. It's not so easy to reduce debt to GDP ratio. So my question is this, against this background, with all the wars and the real issues that are not primarily monetary policy, how can central banks do what they need to do? I will just remind you that about 20 years ago in this session, or 25, Paul Volcker stood up and said, please don't go to the area that you cannot have competence to deal with because it will upset your independence in the longer run. So with this in mind, let me just put it on the table.
Okay, thank you. So I will we'll take that question. How do you incorporate and react to all of these tectonic, I think that's fair to say, tectonic tensions? I'm going to start with Lesecha and then Abdel, and I'll come back to you, Ilan, if that's okay.
As a South African commentator who says that as central bankers, we should not play politics. And that is correct. But he says that you can also decide to ignore the politics, but the politics are not going to ignore you. And that is what we are facing here. There are these tectonic shifts. And so as an emerging market central bank and thinking about the stance of monetary policy going forward, I look at the two things that I had mentioned. The first one had to do with the debt situation. A point of departure in arriving at our neutral rate is to look at foreign neutral. And you talk to the advanced economy central banks, they say that, well, neutral might have risen. By how much, we don't know. But we think that it has risen. That complicates life. But then we come back to the issue of what is then driving foreign neutral. And I think Jason was earlier in the earlier point when he was talking about the global debt situation and what it actually does to rates becomes a very important point. But as we think about it, think of this, that the debt situation that we face is not a classic situation, bar for low-income indebted countries. It's not that situation where we would worry about default, but it's a debt situation that would get us worried about the prime borrowers moving rates against everybody. And so if you have the United States continuing on its debt trajectory and long-term yields in the US rise, they're going to have to be rising across the globe. And it becomes an important point to bring to the fore. The second has to do with other tectonic move, which has to do with the trade and the trade tariffs. And at the moment, the focus had been on the tensions between the US and China on tariffs. But it complicates the situation because it seems to suggest that no one else will react. And the point that was made said that in the emerging markets, we to be okay. But the public would be driving something else. If they are doing it, why can't you do it here at home? And before you know it, you will have countries imposing tariffs. And by the way, including it had happened in South Africa. Earlier on, people were talking about solar panels. And there was a move in South Africa to say that we must impose a tariff on solar panels. It says that, sorry, we have got an energy problem. We actually need more of this to solve our energy problem. But it was, oh no, but we could be building our own industry. Says, sure, you have had a power problem since 2008, and 16 years later, you can't turn around and say that you're going to be building your own industry. If it couldn't be built in that period, you have a problem. And it is all of these relative things that we have got to worry about, because then if these tariff reactions take place around the world, it's going to complicate the disinflationary process, and central banks are going to have to be asking difficult questions. What role gets to be played here?
Yeah, excellent. Abdul, Governor.
Yeah, if I can add from the perspective of emerging markets again, I'll cover two aspects. First, in terms of from regional perspective, and second, perhaps maybe from domestic perspective. I think from regional perspective, I think what is important, number one, is for us to strengthen regional grouping, to increase our voice, to improve the bargaining positions of EMEs to secure more just and equitable terms for trade. Second, in terms of pursuing a deeper economic integration, this is where to build a more cohesive blocks that have greater influence in trade and investment globally. One example in ASEAN is the ASEAN's Economic Community Strategic Plan, which is a prime example of how we can further promote trade and investment linkages in the region itself. So this has a safeguard in terms of the current environment where the global trade is weakened. And third, in terms of importance of to continue pushing for reform of multilateral institutions. This is where EMEs must not lose sight of the need to push for reforms in the multilateral institutions so that where we can seek increased representation in the decision-making process of these institutions. And of course, this will not only improve the legitimacy of these institutions, but also prevent the deepening of divisions. Second point, from the domestic angle, being an emerging economy, our role is broader than just monetary policy. So that's where we are also involved as a policy advisor to the government. And we also have a seat at the Fiscal Policy Committee. So that's where the policy coordination between monetary and fiscal is important in terms of addressing the debt part of the issue. And third, in terms of, I would say this is indirect. We create a conducive monetary conditions to ensure that despite all these challenges, growth is forthcoming. We have a sustainable growth path, and we also have price stability. So I would say both from regional angle and domestic angle. Thank you.
Interesting. As I recall, Jacob, the governor of the Bank of Israel also has an advisory position with the broader government, private advisory position, but it's sort of institutionalized, as does the governor of the Banco de Mexico and other governors has that sort of formal structure you just referenced. Ilan, please, and then I'll go back to the floor.
So I think Jacob made a very important question. It's a question from a former governor to governors and former governors, all about governors. And I don't think central banks can do everything and should not own everything that cannot be done. Because sometimes if you want to own what everybody else wants you to do, it's going to be very difficult to deliver on that. What you can deliver is what I think central banks are doing. I think they're not doing badly in terms of independence. We have seen several in emerging markets with doing their job, even difficult jobs, where in a polarized world, in a more extreme world, it has been much more difficult for the independence to be maintained not de jure, but de facto. And I think I've seen several of them, and I think this is working. That's about institutions, and it has been relevant. In Latin America and Caribbean, I think central banks did their job raising interest rates at a good timing, and that helped inflation go down. And now again, we are seeing even the Central Bank of Brazil going in the other direction from the Federal Reserves. So it looks like they are independently doing their job, and I think it's important. Having said that, it doesn't mean that central banks should ignore whatever is happening, because this is very important for the capacity to do it. So the issue is what exactly is the role. Central banks that are also regulators have a very important role, because that means creating the stability that we really need for growth, for debt, for big challenges. So that's a very important one, and you should not minimize that. That includes also financial inclusion and all the new payment system and all of the digital currencies. So there's a lot of things to do that I think central banks can contribute. But let me end with a more abstract concept, which is we feel the polarization every day. The tensions that will become some other word later, or we feel it there. And that is reflected in everywhere we are. And we're missing spaces where multilateralism happen. And I know central banks talk to each other. At least I had to fly to Basel 6 times a year, 2 times a year here, 2 times a year G20. There is a space between governors that can talk to each other. And that's a very important space. In the same way we have space between the multilateral development banks, there is a space between governors. So don't minimize the fact that governors can talk to each other, that can try to feel a more technical way in a less polarized way.
Yeah, and I'm just going to add to that, which is that it's also a space, particularly when it's only the central bankers, where central bankers can show full humility and lack of understanding of issues or share desire to solve problems and have that open dialogue that is much more difficult in the SECHA. So.
Yeah, I mean, very important. And central bankers, we talk to each other all the time. But maybe therein lies our problem. We are talking to ourselves.
We're talking to ourselves right now.
Right? And so we will meet and we will have our own grieving sessions, and we would learn from each other, and we will say how bad the situation is, where we are operating, and so forth. And then we live from there. And when I came back to that issue of the debt and the calibration of fiscal and monetary policy, one of the big elephants in the room during these meetings had been a lack of an engagement with ministers on these things. And we would be comfortable. We will go to Basel and we will complain about the ministers and fiscal policy. And then we do not talk to them because we are also protecting our own space. But it is in the forum like G20 or the IMF, where you have got the ministers and the governors in the same room, that we should actually be framing the questions and talking to each other. And lastly, central bank independence gives us an opportunity to talk truth to power. We have got mandates, we can talk truth to power. But can we talk truth to our people is a phrase that was used by someone during these meetings. Can we talk truth to the public? And this brings us into importance the issue of central bank communication and who we actually communicate with and how we frame the message to take the public with us. And I think that the lesson here is where institutions are under threat, the best defender of the institutions is a public that understands the role of that institution and could then stand up and say, this institution have got to be left on its own.
Can I comment
Very
on
good.
that?
Yeah, you can. There's discussion breaking out. That's good. That counts as a standing ovation at the G30. That's breaking out. Just to be clear, that is 100% support. Ilan, please.
So, two things here. One is I do believe that talking central banks with the rest is very important. At the IDB, for example, we have a network of central banks and ministers that we put them to talk together. It has been there for some time, and I think it's very relevant. Now, we cannot minimize the difficulties of central banks to operate in terms of communication in this polarized world. In a polarized world, there's no middle. So you go there and you say your opinion on anything, you will be, even if you don't want, you will be perceived that you are in one side or the other. So yes, it's very nice to be able to talk more and to say more. The reality is that I don't think it's easy today in any country for central banks to just have their opinions on difficult issues and not to be seen political.
Yeah.
So let's be realistic that it's nice to talk to the rest, but it's not easy if you want to be independent. So that's really cool.
Yeah. Okay, I'll throw my 2 cents worth in, and then I'll go back. This is very important points that all of you have made. A couple observations. One, in truth to the public. If something is macro critical, in other words, if some policy or geopolitical event or other is affecting the central bank's policy, affecting the outlook, and it's going to cause, you have a responsibility to talk about it. You have to, and you have to choose your words carefully. And if you start to think that it's being political, you're being political not talking about it if something is the elephant in the room that's affecting the thing. And that's the rule of thumb, and you find your way to, with the right adjectives to do it. That's the first. The second, to go to heart of Jacob's question, look what you sparked, Jacob, with your question, is this gap between the profound level of uncertainty, risk, tensions, conflict in the global economy, and the relatively low levels of risk premia volatility and others in financial markets. And as a central bank, this is my perspective, I think others probably share it, there's no sense, sometimes people say, well, what you should do is you should save your ammunition because something bad could happen and you need to provide. That's not what you do. Right? You wait and see what actually happens and you react to it. So from a monetary policy perspective, there's no anticipatory action for it. But from a financial stability perspective, you absolutely overtrain on the prospect of quite sharp moves in risk premia, drying up of certain markets, correlations going to one, et cetera. Because this is the time you can do something about that, because it almost certainly is going to happen, would be in some way, shape, or form, and in ways we can't fully anticipate. Okay, sorry, we should go back to questions. Can I go, I'm going to take two, given that we have last time. David, and then gentleman over here, David Marsh, in the middle, and if we can get a microphone over in the third row. Get one there, sir. Can you get a microphone to that gentleman? Yeah. So we'll take those last two questions. I'm sorry, apologies for a discussion breaking out, but that's what happened. And then we'll get responses and finish. David.
Yeah, thank you, Mark. It's David Marsh from OMFIS. So I'm not a central banker, just an ordinary guy who came in from the street. So this is your chance to speak to others outside the central banking community.
Speak to real people.
Yeah,
like,
exactly. Yeah.
Yes.
So the question to Letitia is, we've all heard a lot about the BRICS currency in recent days and the alternative payment system. Probably you can't tell us too much about that. But the question, if I'd like to frame it like this, does the practical implementation of some kind of non-dollar standard, does that depend more on the BRICS countries themselves or on what the United States either does or does not do?
Okay, we'll save that question. And, sir, yeah.
Thank you, Mark. Satya Das from Green Powerhouse.
Oh, yeah.
And it's great to find a fellow Edmontonian on the stage.
That's good.
And I was really struck by the challenges that were faced in filling, first of all, in ASEAN, the $100 billion infrastructure gap. And we talked about blended finance. But in order to really go after the green transition in the global south, you also need patient capital, because big ticket projects have 7 to 15-year capex recovery, and most private capital is not that patient. So in terms of whatever may be needed in new financial architecture or market infrastructure, I would really appreciate having the panel's insights on how we can crack this dilemma of a sovereign debt crisis where 90% of Nigeria's revenue is going to service the interest alone, and the other challenges faced in inclusive societal development, and essentially how, as you say, the central bankers of the G20 can work with the ministers in finding frameworks that actually move us forward. Thank you.
Okay, big question. Okay, great. So I think the first David's question from the street. This is what everyone's talking out there in the streets of Washington and around the world is the BRICS currency discussions and the motivations and the drivers behind it.
Let me find a less controversial way of putting it. My BRICS...
We were talking about transparency and talking to people.
My BRICS counterparts ask me, where does this thing originate from? So as central bankers in the BRICS community, we ask ourselves, whose idea is it? And we can't tell exactly whose idea it is.
That's reassuring.
Right? But it turns out that ministers of foreign affairs seems to have mentioned and talked about this. And I've got no doubt with some political commitment the thing might happen, but it's just so way out. I mean, let's put it this. As the central banks, we have been talking about the interoperability of our payment systems. That is where we're spending our energy. Talking about cross-border payments. That's where we're spending our energy. We've not been talking about a currency. In any case, as central bankers, we can't determine the currency. Currency is a political project. So somebody must make a political call and say that that is what is going to happen. But just looking at what has been happening with BRICS, we have got a swap line with the People's Bank of China. They have got a renminbi clearing center in Johannesburg. If there is a shortage of RMB, they will put RMB into the trading system. And if there's a shortage of rand, we would do the same. The Indians have been talking about that, and we'll put a swap line with the Indians. And the BRICS have got a contingency reserve arrangement where we would cooperate on this. And we have tested this thing, and it works. Suffice to say, one of the countries couldn't quite settle because they are excluded somehow, somewhere. And so we can't deal with that, and so we are tuned into the global project, and I must declare my conflict of interest because I chair the FSB's cross-border payments committee. So my own interest and bias is towards the payments and making sure that we have got functioning, efficient, cost-effective payment systems cross-border. And that is where I focus on. And it's within the remit of central banks to do that. Currencies, politicians will have to take a decision elsewhere. A currency without borders, without a central bank is going to be an interesting currency to go with.
Okay, very good. Governor Gafoor, I'm going to give you the broad remit, and then I'll have our host finish up in terms of this important question of Satya Das on financing with fiscal capacity, role of blended finance, other aspects. Yeah.
Thank you, Mark. Yeah. Thank you for the question. I think this climate and transition finance remains one of the key priorities for the emerging market, especially in the Asian region. And there are many estimates out there in terms of financing requirements. For example, I think we know that it is massive and to the tune of trillions of dollars. For example, the UNFCCC estimates about $6 trillion is required by 2030 towards transition into energy transition alone. And in the case of Malaysia alone itself, at very least, about 1.3 trillion Malaysian ringgit is required for just energy transition alone. But beyond that, we also have greater need for greater capital flows towards funding adaptation, towards funding nature and biodiversity conservation projects. So that's huge. Aside from financing, we believe there's also pressing demand in the EMEs for technical capacity, including R&D, providing affordable technology and expertise. Going to financing, why we are pushing for blended finance approach is because we believe that it's just so unaffordable to rely just on financing for this transitioning. So there needs to be some kind of like grants. This is where we are working closely with the multilateral development bodies in terms of, like for example, we work closely with the IFC, the AIIB, the Asian Infrastructure Investment Bank, and investors as well. So that's a blended kind of financing. You have equity partnership, you have grants, and you have financing coming in as well from the investors and the banks. So that will hopefully reduce a bit in terms of the cost of financing. But more importantly is in terms of once we have this blended finance approach, what are the kind of expertise that these MDBs can also bring along to the emerging markets? So that will reduce costs in terms of availability towards technology and data as well. So this is how I believe it could reduce in terms of the cost for financing for the emerging market in terms of the transition financing. Thank you.
Excellent. Okay, you get the last word, rightly so. I mean, this is your life. This question is about your life, right?
No, but I just want to comment that I really like the question on the street on the BRICS because it shows exactly what we were talking before.
Yeah.
It means you heard the answer. Central banks have no idea where it comes from. Last week, the BRICS announced that they're really into the new currency. And this is the reality of this polarized world. So if we want to talk to others, maybe it's not with the finance ministers, maybe with your own politicians on that. And the rule that Mark mentioned, which is it affecting monetary policy? Maybe yes, maybe not, but this is where we are now, and I think this is a very important point. Because you all know swaps, interconnections and all of that. This is a different subject that we all be dealing, but the new currency is a different story. And that really needs, as you mentioned, some central bank of the region, somebody else. So that's a different story. So.
Yeah, that's a great place to put it. And it is a different and related story to the topic of our final panel, which is around the future of money, some of which goes to exactly what all of you touched on. Lesecha in his role at the FSB and cross-border payments and the core element efficiency, resilience, and Governor Kafur on mentioning a series of innovations, including Nexus, Enbridge, and others in ASEAN region and beyond in some cases to improve cross-border payments. These are all intertwined, and so this group is sophisticated. You would have heard the messages from them. You'll also hear more from the next panel in that regard. So if you can join me in thanking our panel. Perfect. We'll do another quick changeover. Thank you very much.
See you.
That's great.
Great.
That was brilliant. Thank you very much. That was great. Yes. So you come off, yeah, and I wait for the last. I will see. I will see in KL. Yes, exactly. It'll be perfect. Okay. Just call us back to order. There you go. It's a relatively. You called them in, yes. Yeah, Jacob will call everyone in. Stuart, can you call everyone in? Come on. Yeah. Okay. So I'm going to start I'm going to stretch out my introduction here just a minute, just as people are taking their seats. I've been looking forward to this panel for a few months since they all agreed to do it, because there are, I mean, it doesn't get much more fundamental than money. Everything's built off it. It is a very easily misunderstood issue. We have with us really the pioneers. They represent the pioneers in the changes in the system, actual and potential, with a rich and, my experience, comprehensive understanding of not just the opportunities, but some of the risks and how they need to be addressed. And I'd be remiss if I didn't acknowledge Stefan Ingves, who is in the audience, who has also helped lead this from the start during his tenure at the Reichsbank, and actually many others. I look around, I can't name them all. But joined by Governor Das of the Reserve Bank of India, and of course, the India tech stack and the innovations there have delivered great benefit to more than 1 billion people, but have been a lesson for the rest of us and increasingly applied around the world. I'll invite him in a moment. Governor Bailey, the Bank of England, one of the, as I say, pioneers here, formed the core under his leadership group of a number of developed economy central banks looking at future of central bank digital currencies, huge research project and policy project at the Bank of England in and around that. And of course, as we all know, the Bank of England is at the center of the global financial system. I just want to put that, sorry, just thought I'd slip that in, that acknowledgement there, Mr. Governor. And Augustine Carstens, I think people will know this, but I just want to underscore, building on top of his long career and successful career as a central banker, as a minister of finance in Mexico, when he became the general manager of the BIS, wow, 9 years ago, is it? 7 years ago, 7 years ago. His first priority was to create what was called modestly an innovation lab at the BIS, but really go to the heart of the financial system and the workings of the financial system. And a number of the innovations that we have seen and were referred in the earlier panel, mBridge being one example, Nexus, others, have come from that, and thinking above and beyond where the system is going through the Finternet and other elements, Augustine. So we couldn't have a better group to discuss these issues, and I'm going to leave it to each of them to take it in whatever direction they wish, roughly 10 minutes each of remarks, and then we'll open it up to your questions and comments. So Governor Das, please.
Well, thank you. Thank you, Mark. Good to see you after a while.
Yeah.
And good afternoon, everyone. The topic today is future of money and payments. So the first observation I would like to make is that the shape of money and future of payments is it's going to be influenced largely by the rapid advancements that we have in technology in this particular space. And I would like to highlight on two aspects. One is the fast payment systems. In the case of India, it is the UPI, the Unified Interface. And I would like to highlight on the efforts of India and few other countries on CBDCs, that is central bank digital currencies, where we have launched a pilot project, 2 years ago. Now, coming to first the fast payment systems like UPI, India is one of the pioneering countries. UPI basically in India has ensured high efficiency, and it has brought in high efficiency into the payment system. The payments are safer, faster, instant, and cheaper. And today the number of transactions that take place in UPI per day is about 500 million transactions per day. And that's a whole, that's a huge amount of, huge number of transactions. But then we are trying to even step it further, and the idea is to reach 1 billion transactions maybe in the next few months. The number of transactions were about 300 million about a year ago. Now it has reached 500 million. Now that is so far as the number is concerned. UPI has got actually a lot of potential for cross-border payments. We have also taken the initiative of linking the UPI of India with the fast payment system of other countries, and we have started the process by linking the Singapore fast payment system, that is Pay Now, with the UPI of India. And the effort is on to have similar arrangements with other countries. And on QR code based payments, we have linkage already with countries like Mauritius and countries in our part of the world like Sri Lanka, Bhutan, Nepal, and we are in discussion with several other countries in the Middle East and in Asia to have this linkage. So for cross-border payments, UPI has proved its efficiency, and this will be particularly easy, very useful for students, for travelers, business travelers, for tourists, and that's it. The third point I would like to mention in the context of UPI is that we have now attempted and actually put in place a method for offline payments. You see, in a large country like India, the availability of connectivity, the connectivity is a problem in remote areas where either the connectivity is weak or it is simply not there. So we have now facilitated offline transactions on the UPI. And the UPI, we are in discussion, as I mentioned, with several other countries. Going forward, I see UPI, the linkage of India's UPI and the fast payment systems of countries, not only in our region, but coming to the other parts of the world. In fact, in France also already in a few places, it is launched in Paris. So therefore, this can actually make global cross-border payments much more efficient than it is today. Now turning to CBDC, the central bank digital currencies, the e-rupee pilot was launched by us sometime in November of 2022. We started first on the wholesale mode, and then within a month we started the pilot on the retail mode. And today it's a pilot project, and we are in no great hurry to immediately announce a nationwide rollout because we want to do the trials, fully convince ourselves about the design features, about the robustness, about the security of our CBDC, and then only think of a nationwide rollout. Now, today we have about nearly about, let's say, 6 million users in the retail payment in UPI, of which about 5.5 million users are the retail customers, that is individuals, and about 500,000 are merchants, shops, and other establishments. The trials are going on. Every day there are learning experiences, and we are constantly fine-tuning our system. Now, I have been asked this question as to if UPI is working so well, why do you go for a central bank digital currency? The key difference between the two is that UPI is a payment system, whereas the CBDC is a currency. It's a liability on the books of the central bank. And it's not only a liability in the books of central bank, it also involves, it is just a replacement for paper money. In India, what we have done is that the issuance of the digital currency, the CBDC, we have the intermediation of the banks also, as it is in the case of the paper currency. Now, I have heard this question also at times that, whether the banks will join or whether the banks will demand a particular commission. Now, it is identical to paper currency, where we issue the notes to the banks issue it to the customers. Here, central bank generates the digital currency, the CBDC, the banks draw it, and the banks give it to their customers. The banks facilitate in creation of a wallet and then transfer the money into the wallet of the customer. The key advantage in this is that unlike a paper currency, you draw the cash and you keep it in in your wallet, that is your physical wallet. In the case of CBDC, you can draw it instantly, and at the end of the day or whenever you want to use, if you feel that you don't need that much of currency, you can immediately online instantly put it back into your bank account. So that way, you can manage, individuals can manage their cash position much more efficiently. Now, few points I just want to mention on CBDC. Number one, first point is that it is highly efficient. The payments are instant, like the fast payment system. Second, CBDC is a great way, as we have experienced in India, to promote financial inclusion. Financial inclusion by, if payments have to be made to, let us say, certain beneficiaries of government support, of government subsidy, the government, or even in a private company, the private company wants to make payments to, its employees, for particular uses. So we see a great potential for financial inclusion, and we have recently, in fact, facilitated money transfer from government for, by way of cash support which the government gives to certain poorer sections of the society. We have facilitated that by way through the CBDC mode. The third is that CBDC has the feature of programmability. You can program it in a certain manner that, again, if the government is, let us say, giving fertilizer subsidy, I'm just giving an example, the farmer can go and encash it only in a fertilizer depot. He cannot use it elsewhere. So therefore, government subsidy transfer becomes much more targeted. Even for companies, if they are giving, let us say, lunch vouchers or some, some other kinds of vouchers, it can be encashed in certain pre-designated, points. Fourth, we have also instituted interoperability between CBDC and UPI. The same QR code works between CBDC and the UPI. Fifth, the feature of offline functionality has also been introduced. Sixth, CBDC indeed has, I think, the biggest advantage of CBDC going forward, and the biggest potential of CBDC going forward is in cross-border payments, which we expect that because CBDC will avoid multiple intermediaries, it will ensure low-cost cross-border payment, cross-border money transfer, and faster and instantaneous money transfer. Now the way forward, and I will be very quick, what is the way forward? The way forward is to have multilateral arrangements, to have bilateral arrangements, preferably multilateral arrangements to begin with at a regional level, and scaling it up at a global level depending on whether the other countries are introducing CBDC. So it can become it can become a model for fast, cheap, and safer transfer of money across countries. What is important in this context is to ensure robustness of design and the safety of the currency. One challenge that we have here is that, in a paper note, the security features, they vary from country to country. But in CBDC, the dilemma will be whether we have common security features across countries, or each country will have its own security feature. Now, these things will evolve as the time passes. And the other point which also has to be looked at is that the anonymity of the digital currency also has to be ensured, because the paper currency has a certain amount of anonymity. So if you have to ensure anonymity, you need legal backing, and also you need technological design in a manner that the anonymity can be established. And now, what are the risks in the matter of CBDCs? First, CBDC, because the payments are online, the payments are instant, it can create a situation of faster transmission of shocks. If there is an economic shock in one part of the world or in certain countries, it may lead to a faster transmission of shock to other countries. The second is that it has the risk of currency substitution. When, let us say, one currency of one country and currency of another country, there is a possibility that, one currency between the two will substitute the other. Now, these are risks, and we need to work on this to find methods and measures to mitigate these risks. And these are challenges. I would not call them risks, but I would call them challenges which have to be dealt with. Third, it may also create capital flow volatility because of faster transfer of money across the border, across countries. So these are risks, but I would prefer to call them as challenges of the future, and technological solutions have to be found for this, systemic solutions have to be found for this, and I think all of us need to work together. In conclusion, I would like to say that the future of currency, the future of money will be digital. There is no escape from that, and there is no need to be skeptical about whether we should have a CBDC in parallel to a UPI, because there are two different systems. They can talk to each other, they can become interoperable, and CBDC is currency, whereas UPI is, as I said, a payment system. And CBDC, because of its design features and because of the, the way technology is evolving, it can have multiple use cases. The true potential and the full potential of CBDC is yet to be seen, and it will evolve. And finally, if I can say, I think CBDC and fast payment system working in parallel, they will act as a backup for each other. Just imagine a situation where the fast payment system of countries, due to some reason, there is a technological problem, and suddenly the system gets jammed. But you have as a backup the CBDC to ensure payments, the payments going on in a normal manner. So therefore, they will act as both fast payment systems and CBDC will act as a backup for each other in times of crisis, or if there is a breakdown in one. We cannot rule out such possibilities. It can happen, and we cannot be complacent about it. And we need to, I think, to conclude, the last line I would like to say, I think CBDC has a lot of potential. Fast payment systems have a lot of potential. They have a lot of potential for faster and more efficient cross-border payments. And I think multilateral cooperation in many aspects, in all aspects of this, including design, including legal arrangements, etc. There is a need for greater multilateral cooperation in this area. I'll stop here. Thank you.
Fantastic. Excellent. Thank you very much. Governor Bailey. Andrew.
Well, thank you. I really want to thank the G30 for setting this panel up, because I think it helps to underline what an important subject this is currently in the world of central banking. I'm going to start with two propositions in the world of payments, which I think attract very broad support, that are important to say, and we've already covered them actually in the previous panel as well as this one. I think the first is that there is a strong need to modernize some key payments practices, and in doing so, an opportunity to improve efficiency and reduce cost. And that's true for domestic and cross-border payments. It's true for wholesale and retail. But I think there is a particularly pressing need, and Shakti Kantor's just referred to it, in the area of cross-border payments, because progress on modernization there has been very slow. So we can do more and need to do more on speed, cost, transparency, and access to cross-border payments. But it's not limited to cross-border. My second proposition really picks up on what Shakti Kantor was saying. In modernizing, we have a golden opportunity to harness the potential of digital technology. And frankly, if we don't do that, then I think we're going to suffer a failure of imagination. There is, I think, real potential here for payments in digital technology. If you take areas like solving late payment for firms by enabling automatic release of funds when goods are delivered, if you take using encryption technology more widely to prevent fraud, these are areas where there is real potential for good. So I think the case for harnessing digital technology is made. So what I'm going to go on after those two sort of opening propositions is to set out some of the implications of doing so, my sense, from an economic and financial perspective. Because, to be honest, I think this area has been somewhat under-examined relative to the technology. And the question, and I am going to strike a slightly different tone to Shakti Kantor here, is do we need to fundamentally change the money and banking system to enable this to actually happen? Yeah. That to me is a key question that we must answer, and this is a good group to contribute to that answer. So a starting proposition is that actually I don't see that we need to change the system fundamentally as a matter of principle, but as a matter of practice there are outcomes, I think, under which it may be necessary. But I think a first best endpoint is, do we need to do it? Not sure, we do. So let me start at a few points on what I call the nature and role of money. It's a bit sort of back to basics, but I think it's quite useful. I think first of all, of course, payments are a key function of money. It's money as a medium of exchange. So by the way, that's why they're core to the interest of central banks, amongst other things. Second, as Shakti Kantor was just saying, we of course have a world where there are essentially two forms of money, central bank money and commercial bank money. And a key feature of this system is that those two forms of money are fully aligned in nominal and real terms. I think the BIS actually developed this term, which is a really helpful term called, I call it the singleness of money. That those two things are aligned is critical to the system, it's critical to the monetary system, critical to the financial system. And of course, it's achieved by a mixture of central bank operations, bank regulation, deposit protection. Now, I would assert that with singleness of money assured, for low value and retail transactions, we should be pretty indifferent at the margin to whether a payment is made in commercial or central bank money. Payment can, of course, be made in something that isn't money, but since it wouldn't have an assured value, this is not, to my mind, really a credible means of exchange. And I think that is, for instance, one reason why we have not seen something like Bitcoin take off as a general medium of exchange, because it doesn't have that singleness of value. But I think it follows that if we are broadly indifferent whether retail payments are made in central bank or commercial bank money, then there isn't in the retail area so much an anchor role for central bank money. But it doesn't mean there's no role. Let me be very clear on this. We have to be clear on this. It's not about a roundabout way of saying we don't need cash. Actually, absolutely the opposite. We should supply cash as long as the public want cash, and certainly the evidence in the UK is that the public do want cash. So we will continue to supply the public with cash. Not an issue. But let me turn briefly to the wholesale payment world and the question of wholesale payment system settlement. Now, there's a risk what I'm about to say, I will be seen as contradicting myself. I think I can argue my way out of this one, because actually I do think that in the wholesale world there is a special role for central bank money. And it's in the wholesale high value payments and settlement of those and supplemented payment systems. So I think in the wholesale world, central bank money acts as the anchor. It's in that world where the anchor is absolutely critical. And of course, that's because wholesale payments and settlement take place using the reserve accounts maintained by banks and central banks. They are directly backed by a promise of the state. They are the core liquid asset of the banking system, and that is the anchor of the system. So if we can be indifferent to where retail payments are made, that's not the case in the wholesale world. And of course, that's long established, actually. This is not a new proposition. It does mean in the Bank of England, we're putting a lot of emphasis on enabling digital and other innovation in the wholesale world. We want to see innovation and encourage it. We want to see it encouraged around that anchor of central bank money, consistent with our core objectives of monetary and financial stability. And if you'd like to know more about what we're doing, we issued a discussion paper over the summer where we started to talk about the experiments that we're launching, including offering a digitally tokenized form of central bank money. Now, I think there are two more steps in the argument. This comes exactly to Jacques de Cantar's point about payments versus currency. I think the first is to ask the question, if we are indifferent on money grounds, whether retail payments are made in central bank or commercial bank money, are we likewise indifferent in broader economic terms? My answer to that was no, I don't think we should be, not at least beyond a very small scale of payments. Another way of putting that question is, are we indifferent to the balance between central bank and commercial bank money in respect of retail activity? Or more directly, why would we want to change that balance? And I would assert that other things equal, we actually shouldn't want to change that balance. Not least because commercial bank money, of course, is used by banks to extend credit directly, whereas central bank money is not. So changing that mix would, I think, at best complicate the credit system, other things equal. And of course, that's essentially the heart of fractional reserve banking, underpinned by the singleness of money. So the final step in the argument I'm going to make is, however, are other things really equal? Are there reasons why in the retail space digital payments need to be done in a newly created central bank digital currency? It's the point that Jacques de Cantar was very eloquent on. So a priori, I would take a slightly different view and say that actually I think commercial bank money, i.e. the banking system, is the best home for that innovation. But, this is very important, but, if that innovation is unlikely to happen, then central banks have to decide, are they the only game in town, and what do they do? And the fact that we haven't reached a conclusion on that question justifies why, for me, and why in the Bank of England, we're continuing to prepare for retail CBDC. Because to be frank, we haven't yet seen enough evidence that innovation will happen in the commercial banking system. Now, I think we have to, as central bank, be thoroughly engaged to encourage it. But if necessary, we have to step in and be prepared to provide that innovation. Although, I say I am not proprietorial on it. So let me finish just on the point, why might it not happen in the commercial bank world? Why might things not otherwise be equal? Well, I think for money as a means of payment or exchange to function effectively, it has to have two components. The first, the money is what we tend to call the train, the economic claim, usually on commercial banks. The second, the payment system, is the rails that they operate on, the infrastructure or the technology with which the claim is exchanged. Now, historically, some of these infrastructures and technologies have developed in ways that have somewhat stymied incentives to innovate, including on occasion due to concentrations of market power. It's important that these structural factors don't stand in the way of innovation. For commercial bank money to function effectively, it's got to keep pace with the needs of the users. So our work on retail CBDC is considering these trends in the payment landscape closely. Absent innovation in commercial bank money, central banks may be left as the only game in town insofar as retail payments innovation is concerned. That's not my preferred outcome, but it's one we can't rule out. So we have to go on preparing, but there is a bit of a difference between, I think, here in terms of what Chapter Cantor said and what I would say, which may well reflect the differences of our respective countries, that I would prefer to see it in commercial bank money. That's the more natural habitat, but we'll see. Thanks.
Fascinating. Thank you very much, Andrew. Augustine, please.
Well, thank you very much, Mark, for the invitation. Great to have this discussion here at the G30. Let me also give credit to Mark with respect to the fact that we at the BIS have really engaged very actively in technology. When I proposed the creation of the Innovation Hub, a key supporter was Mark, so I couldn't have done it without Mark support and vision. So your vision also was very, very inspiring. Let me build on what Andrew and Shaktikanta just said. I think when we started all this debate in serious, like 7-8 years ago, or probably a little bit more, a lot of the discussion was started by the popularity that Bitcoin, crypto, and then stablecoin received. We were challenged. The central banks usually were not challenged with respect of our basic monopoly, which is the provision of money. Now, this is not the first time in history that private sector efforts tried to displace central banks. Eventually, we went through the same story. I think now basically, in terms of money, legal tender has reestablished its role, and that's because it has come to fruition that there are at least three things that are important that central bank money has, and the money also supported by commercial banks. One is singularity, but the other, very associated with it, is finality of payments, where the finality of payments is guaranteed by the fact that wholesale payments, but also retail payments are settled in central bank money through the banking system. So also for retail, CBDC money is very important. And third, because I think that we should build on the trust that the central banks and money supported by the central banks and the commercial banking system has there today, and it has really taken many centuries, I would even say, to build this trust. We need to build on that, so that should be the core of whatever we think in terms of money and payments. Stable coins will not really work, at least from my point of view, just to start with, because from definition they are not stable. That's why they have to put the emphasis of the accent on stable. They have to work to make it stable. And I think it should not be able to compete against something that is already stable, and that is the one that is backed by the central bank apparatus that has been put there together. So for me, not only the development of payments, but also for the future of the financial system, we have, and I here fully concur with Andrew, we have to build on the two-tier banking system. I agree with Andrew. CBDC at the wholesale and retail level have a space mostly in the wholesale level. I think it's very important now that we move into digitizing commercial bank money. That can be done through tokenization of deposits. I think that would make commercial bank much more efficient, not only in the payment space, but in many banking spaces. We already in the BIS, we have a project where Bank of England, we are working with the IIF. It's called Project Agora, which basically we're tokenizing central bank money, tokenizing commercial bank money, and the immediate application for this would be cross-border payments. But if we get it right from the point of view of the tokenization of commercial bank money and central bank money, we will have, I would say, a huge pillar for the development of the future of the financial system. Because digitization should not stop at the payment level. I mean, a lot of this discussion of digitization and applying technology has been spread by the idea of inclusion, by the idea of very high transaction costs in cross-border payments. But if we see inclusion, where even though the inclusion figures worldwide are very poor in the payments and the banking area, they are even poorer if you go down the complexity of financial transactions. So I think we can enhance the inclusion in financial activity in terms of sophistication, in terms of granting loans, of bringing saving instruments to broader parts of society, bringing asset markets to society, bringing insurance to society, if we manage to make them more efficient. We have been exploring a way of doing this through what we call the Finternet, and the Finternet builds a lot on tokenization. What tokenization is very important because through the tokens, you can build into the representation of an asset regulation, cybersecurity, and programmability. The settlement can be made very efficient. It can be atomic settlement that can save huge amounts of resources in terms of collateralization. In the short term, it might need a little bit more liquidity, but I think the savings overall can be compensated, you know. And basically, the technology is there. There are three areas where we need to work. One is on the technological area, and we have already unleashed a lot of research in that area. Then we need to work on the financial economic architecture on it, and for that, this two-tier banking system is essential. For me, the next step should be to tokenize government securities. For me, the trilogy in any modern financial system is central bank money, commercial bank money, and government securities. We need to really build that trilogy fully, and it's a low-hanging fruit. If we tokenize government security, even the access to government securities to the population will be far bigger. And then on top of that, we can start building on other financial assets and bring together a financial system that fully embraces technology. I think that the transaction cost would be abated. I think the security can be enhanced, and the efficiency. I think a big problem that we have Here, India, I think, distinguishes itself because you have developed tremendous systems to leapfrog very quickly, but it's very difficult to achieve what India has achieved. Now, I think the future through tokenization, but even to some extent of the way India has provided, is that precisely it allows to leapfrog. If we go trying to build on legacy systems, it becomes extremely slow and very, 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 very difficult. We have seen this application of technology, the way technology is applied to different areas of society, has been basically by leapfrogging, you know. At some point, you know, you don't use dial phones any longer. At some point, you know, you don't use maps any longer. Everything is in your iPhone. Why shouldn't we aspire that you can do most of your transactions through your iPhone? The technology is there. So I think that we need to have this broader vision. I think it's great that we have been focusing on money and payments because that will establish the foundation. Yep. But we also need to start designing the way forward. Now, how should this way forward be created? It has to be a private-public initiative. Mostly the client-facing system should be private, but also the authorities should provide essential pillars to it. One essential pillar, again, is central bank money, the two-tier banking system that gives us singularity and gives us finality, but we also need to build the rails and the regulation and the legal system to allow all this technology to be applied to the future of the financial system. So it's very ambitious. I think that we should embrace this challenge, but if we bring together public and private sector, I think we can get there. And this exercise that we have started already with the IIF, we have 7 central banks working with 44 financial institutions. Eventually we'll broaden it up, but I think it's of the essence that we start finding the building blocks, the key building blocks that will allow us to aspire on a far more efficient but digitized financial system.
Fantastic. Outstanding. I'm going to make 2 comments, so get your questions ready. The first, which cuts across all the panels, all the panelists rather, and a point Andrew emphasized, particularly building up on the BIS, is this core point about the singleness or the singularity of money, and that ultimately what is money has to be able to be linked back to central bank money. And if we went back 7, 8 years ago, and there's a parallel set of discussions and innovations that go on that do not do that and will ultimately die on the vine, in my view. But there may be some things to take from those innovations that help to deliver this leapfrogging vision that was just described. And so this, I'm going to ask a question and then get from the audience, which is around stablecoins. And the reason I'm raising it, I used to think that the issue ultimately with stablecoins is the only way for stablecoins to be fully stable was to be backed by the balance sheet of the central bank. And if you're backed by the balance sheet of the central bank, aren't you a central bank digital currency? But often with innovation, you have temporary structures that help link into a tokenized world, which is what stablecoins today do, private stablecoins. And so just how you see them and how you see the time horizon of maybe the pathway where the CBDC steps in. And Andrew, you may have a thought, or Augustine, yeah.
Well, I agree with you. We've done a lot of work on, preparing to regulate stable coins, and we really end up, particularly for what I might call the more systemic ones, we really end up just where you are, which is you end up saying the only way to make them truly stable is to have them fully backed by central bank reserves. Yeah. In which case you've got synthetic central bank currency money. But I think you're right. So you may say, well, you sort of dismiss it there, but I think you're right. The question then is, yes, but do you get sort of goes to what Augustine was saying. Is there some stepping stone by which that's a way to achieve tokenization? Now, I think the challenge we always get back is it at all a commercial proposition if you're sort of restricting it like that? But I think you have to go back and say anything else that it doesn't have that characteristic doesn't have the characteristic of money. That's the ultimate point.
Yeah. Stable coins, the way they have been presented by and large, try to have two objectives. One is to make money out of issuing money. And that's something that the central bank do not do. We don't try to get money out of, playing with the backing of the currency.
Well, it's, except for seniorage, but.
Yeah. And the other very important aspect is why we need to ask ourselves why at some point it was perceived that we need a stable coin. Digitally speaking, and here I go to the point you're saying, there is a lot we can learn from the technology that is behind stablecoin and Bitcoin. Now, the real problem is that the representation of money that we provide today doesn't have the technological capacities that in many digital financial transactions is needed. And that is a gap we need to close. So that's why I think that based on central bank money and based on commercial bank money, we need to close that gap. Yeah. But technology that has been provided is very valuable and we need to use it.
Yeah, I'll just make a short observation. In fact, I think Augustine has put it very well, that you have to add that prefix of stable to show that it is a stable coin or stable money.
Really stable coin.
Yeah,
really stable.
I have a fundamental question here, and I have actually a very strong reservations on these stable coins and all that. And the question is, money, currency, has to be fiat currency, has to be currency issued by the central bank on behalf of the sovereign. Stable coin is private money. Bigger question is, are we comfortable to allow a private money to dominate the payment system, or are we comfortable in having the central bank currency, that is the fiat money, to dominate the payment system, dominate the entire ecosystem related to transactions and payments? So I think that is the larger question. And second thing is, where it is central bank money, central bank digital currency, I think this was again a point which Augustine made. I mean, there is no settlement risk. It is a finality. Once I pay CBDC to somebody, it's money. Yeah. Whereas, there is no settlement risk. And we have seen this merit actually greatly in the wholesale pilot which we are trying. And for example, in the government securities market, we are using the wholesale CBDC for government securities secondary market transactions. So we have found that there is no need for, it's a T+1 settlement. Now, there is no need for collateral. There is no also, in fact, now the T+1 becomes irrelevant. The settlement is instant and the settlement has finality. So therefore, the larger question is whether we need private money intermediation to make our payment systems, make our money system more efficient, or something which the central bank can do it. And what is the great advantage that stable coins, the private money has, about which I am very uncomfortable? What is the edge it has? What is the advantage it has over having a fiat money or central bank money? I frankly do not see any great advantage, and I see a lot of risks actually inbuilt there.
Very good. Okay, thank you. I'm going to start with Axel Weber in the front row, and then Governor behind.
Thank you. Just maybe one remark. I think it's a very important distinction the Governor did about coins or payments and payment systems. I think where you can add stability is on payment systems, because if the net exposure of these systems are covered by central bank money, you can actually add a lot of stability when these things need to be settled and brought down. And it's only the net exposure that we don't need a full backing for many of these payment systems, where I think there could be a lot of work. Two questions to the panel. The first, you're embarking on this journey, and I think it's a worthwhile journey, Augustine, that you do in BI. But how you make sure that we're only at the very start of these technological developments, that what you put in place doesn't actually sort of determine who the winners and the losers are, in which direction the system goes. And I think the only way to do it is to provide a minimum sort of platform and let innovation flourish on these platforms rather than determine with current market players what the direction is. And so that's a question of how you secure that. And then the second one that I have is, where do you see the long game of this? I think you said rightly, and some of you said, well, we want to have a decision whether, or we want to take a view on whether it's a public service and therefore central bank money should do it, or private money. Wouldn't it be better you define the criteria that you as a public sector want to be seen achieved, and then if that can only be achieved by central bank money, then it must be central bank money. If it can be achieved and convenience added by a private solution, then that is at least equivalent and probably in the eyes of the private users even preferable to a public solution. So I would come from the standards, the protocols, and what you need to see as information attached to payments in that sector, rather than defining the solutions themselves. Thank you.
Okay, great. And if you can just pass the microphone to Governor Yaron right behind Amir, and then we'll get comments and we'll take other questions.
First of all, great
and
panel.
Thank you for your service, by the way, and thank you for being here.
Thanks, Mark. This is kind of related to what Axel just saying, and to what Andrew was saying. He wants to start with wholesale and essentially filtrate into the retail. And at some level, is there a trade-off between interoperability on the one hand, and on the other hand, letting the marketplace and each institution of these 44 institutions being in Agora, Augustine, if they are going to compete on the marketplace of developing these benefits that you were mentioning. So I can see, the tokenization for government securities, that can be done. But the more you go into different elements where tokenization might help, you might need a niche or a private market, and the benefits for different private institutions to cooperate may be very different, and you find yourself again in the central bank needing to put it on. Thank you.
Okay, that's two great questions. So I'll start with Augustine, work this way, if that's okay, and then we'll take two more from this side, please.
Yeah, technology has advanced tremendously. Some years ago, our concern was, are we going to choose a technology today that will tie our hands into the future? And at some point, we will find that the technology we did today is completely useless. Now, technology is such that you can develop many different systems, and eventually they will talk between each other. The other is that you can also develop a community of developers that will make this work. If you see how the internet and how your cell phone work is due to a community of developers that, following very basic principles, you can build something that works really well, that is secure, and so on and so forth. Some guidance in terms of regulation is important, and in terms of governance is very important, and I think the authorities should concentrate on that. But there should be a very agile dialogue between the authorities and this community of developers. Commercial banks are very important developers. Each one of the large banks have 1,000 developers. I don't know how many. Now, also the system needs to have flexibility to allow other financial services providers to hook into the system and make it more efficient. There will be more competition, that's for sure. Now, what is the final game? At least this is my own personal view. It's not the BIS. For me, I think a very important aspiration is that we have a financial system that is more user-centric. Today, when you think about a financial transaction, you think about a commercial bank you need about a specific product, and you have to go through that. Whereas in many other services, what you think is in the user. You know, what you want is to have a system where you can do as many transactions with whoever you want at any time in any place in the world. That's probably a utopia, but I think that should be our outcome. And I think it's doable. I think it's doable. Now, with respect to your question, I think that what is important, I mean, when you develop a project, you need to start with small, and you need to start with a core group of central banks and commercial banks. Now, at the end, what we are trying to produce in the very short term is a minimum viable project. Will not be operational, but it more than anything is perceived as a public good. Because at the end of the day, if we don't generate the networks, it will not work. So there is not the aspiration that those who are today pitching into the development of these projects will be the ones who will be running it. No, that's not the understanding. The understanding, we're going to develop this because it will be a platform to hopefully contribute to the build-up of the network. If that network doesn't catch on, it will be useless. So we cannot think that it will benefit those who are working on it to date only.
Fantastic. Andrew?
So I very much agree with you, Axel, on your second point on the criteria. And I think I very much agree with you on the way in which you sort of ordered the criteria between central banks and commercial banks. Now, I think on both questions, I come back to this distinction I made between the rails and the trains, because I think it's important here. I think particularly, let me be really frank about this, if the rents that are being earned from the rails act to inhibit innovation and act to inhibit competition, then we need a different solution. Shaktikantal's absolutely right. I think you were sort of pointing to this in one of your interventions. And that is why we need retail CBDC on the table. That's one reason why we need it on the table. Because frankly, if the rents are going to inhibit the innovation, to my mind, given what I was saying earlier about I think the case for the innovation is clearly there, then we need an alternative solution.
Great.
Two short observations. Involvement of the private initiative when it comes to central bank currency. I think I see that the private sector will have a role, but only as a service provider to the central bank. Second point, I would like to mention that when it comes to stable coins, I foresee a situation where the stable coins will be dominated by certain big companies, large companies which are located in a set of countries. And if that system dominates the payment ecosystem in individual countries, then that raises huge concerns about individual countries, individual governments losing their sovereign control over their money system. So that, I think, has to be also kept in mind.
Very good. Excellent. Okay, we'll take two more questions. I'll start with Brunello here, and then Stefan Ingves. Actually, we'll take three. Brunello, Stefan, and Piyush Gupta. Brunello has a book just out on this subject, so there you go. Available today, right?
Yes.
Yeah. Okay.
On Amazon or in UK bookstores.
Okay.
Actually, on the Commonwealth. So two questions, if I may. One macro, one micro. So on the macro, so as a bit of a segue to David Marsh on the BRICS currency, we all kind of agree that this is not going to happen anytime soon. It's not even an idea, because where would you put the central bank? Moscow, Brasilia, so it doesn't make sense. However, there's an interpretation of it that could be a bit more interesting, which would be China building the rails, to use Andrew Bailey's definition, along the Belt and Road Initiative countries, and then having the renminbi, all over the countries running on those rails. So the geopolitical aspect of CBDC, that would be my first question. The second, on the micro, Governor does talk about anonymity, but in reality, CBDCs would probably protect only privacy. But even privacy is not enough. Some critics of CBDC says what they really fear is that once they adopt CBDC, the government can decide itself to shut a person out of the system, given the programmability. So how would you respond to that kind of critic? Thank you very much.
Thank you. If you just pass the mic down to Governor Ingves.
Well, first of all, let me say that this is a remarkable panel, because I started talking about these things about 10 years ago, and it would have been absolutely impossible then to discuss the way we discuss today. And kudos to all of you, because back then, basically, I was told, can't you just tell your citizens to use physical cash and stop it? And the answer to that is no. But that's not really my question. My question is the following. Actually, what we are talking about here is fiat money. And fiat money is actually decided not by central banks or created by parliaments ultimately at the end of the day, because otherwise you just don't know what you have. And in that environment, it took us a long, long time, going back to the late 1800s, to come to the conclusion that in most cases, and that was in a world when everything was on paper, it would be okay for the central bank to be the sole issuer of physical cash. Now we're moving into a world where everything is going to be digital. And that, of course, raises the whole issue of to what extent it should be possible for the general public to hold fiat money in the form of digital central bank money. And who is to decide that? Is it the political system, ultimately, at the end of the day? Or should it be up to the central bank themselves to come to the conclusion, no, just let's ignore providing the general public with digital currency? Thank you.
Okay. And Stefan, if you can hand to Piyush, please.
Hi. Thanks. You know, if I had to very succinctly try to define the differences, the commonality, everybody agrees there's power in tokenized money. You can program it as atomic, real-time settlements. The subtle differences, Governor Das says, let the central bank do it. Governor Bailey says, let's put a threat on the table, have retail CBDCs just in case the private sector in its rent-seeking capacity doesn't want to innovate and doesn't want to do it, so let's have it in case. And Augustine says, let's lean in and help the private sector use and tokenize commercial deposits to create something. So end game is the same, it's just three different approaches to how you might want to deal with it. Now, I tend to believe that you know, what Augustine's suggesting works. In Singapore, we have programmable money exactly as you have, sir. We have purpose-bound money. We have the government payments going. We have tokenized government. But MAS has leaned in to help us create that with commercial deposits, tokenizing commercial deposits, as opposed to issuing direct central bank currency. So my question actually is more to Governor Das. Why would you believe that the commercial banking sector would not lean in and would require and necessitate the central bank to take that step?
Okay. Great. 3 questions. If you want to comment on the BRICS thing, you can comment, but you don't have to. Let's put it that way. A core question about access, controlling access to the system. Is that a risk that comes up? Secondly, in effect, around who decides the limits to access to retail central CBDC, and are there limits on it? And Governor Das, specific to you from Piyush. So, do you want to start? Why don't you start?
Yeah. So I think broadly 3 questions I have noted down, and I hope I have understood them right. With regard to the privacy question that was mentioned, I would like to, you mentioned that government can shut off somebody from the system. Now, why should that impression come? The way I look at it, so far as India is concerned, the Reserve Bank of India Act has been amended by the government, where the Parliament has delegated that responsibility of issuing notes, bank notes, by the central bank. All that has been done is that it is mentioned that the Reserve Bank is competent to issue bank notes, including digital currency. So therefore, already it has been legalized. And we see CBDC as a replacement of the paper currency. So if you have an apprehension that the government can shut off somebody, the government can do it also for deny somebody to avail paper currency. Now that doesn't happen. It will never happen. And you have a legal system. Why should, there has to be some basis on which government can do. It cannot just be a, discretion left to the government. So that is one point. Second thing is with regard to Stefan's point, you said that fiat money is created by parliaments. Absolutely right. But it's a delegated function so far as the central banks are concerned. The government has delegated this responsibility. I'm talking about India in particular. The government has delegated the Reserve Bank of India, has authorized the Reserve Bank of India to sort of issue currency notes and operate the monetary system on its behalf. So it's a, Reserve Bank derives that responsibility, derives that function from the parliament, from the sovereign. The third point with regard to Piyush's point that, why not commercial bank? Now, I'm just talking of paper currency vis-a-vis digital currency. In our system, in India, the paper currency, the notes are printed by the Reserve Bank of India. Then it is supplied by the Reserve Bank of India to various commercial banks, and they then dispense it, they distribute, they give it to their account holders and others. Here the same system remains. The Reserve Bank creates the digital currency. It remains a liability on the books of the Reserve Bank. The commercial banks draw that money and they dispense it to the public, to the members of the public, to their account holders. So it is not in no way different, and it does not in any manner sort of dilute the function of commercial banks. It does not take away anything from the commercial banks with regard to what they are doing today.
Excellent. Andrew, please.
Well, let me say two things. On the first question, on the geopolitical question, I think it's a very, very good question and a powerful question. First of all, I don't think there is any good reason to want to fragment the rails in cross-border payments. And I'll be blunter than that. I think those who do want to fragment the rails probably are doing it for very much the wrong reasons. I mean, if you think you can avoid sanctions by fragmenting the rails, then A, that's a bad reason, but B, we should be very alert to it. But I think the best way to, frankly, avoid a fragmentation of the rails is to innovate and make sure that the rails are actually, modernized and up to speed. Otherwise, there is, of course, an economic case for fragmenting. That's the issue. So, I think the geopolitical question is, frankly, as a reminder that we need to, frankly, keep the rails. The rails need to be modern, efficient, and operating. We go to Stefan's question. It's a really good question and a really hard question. I do think Stefan's right about fiat money. Of course, it does have its central bank money, but the origin, is in parliamentary authority. And I think it is, we've all in our design of retail, well, certainly we have in our design of retail CBDC, and I know the ECB has said, we really actually would set a limit on holdings, and that's to do with the risk of disintermediating the banking system, really, which we don't want to see. Now, I have to say, I'm going to say two things on that. First of all, I know I'm probably a bit sad in this respect. To get into this question, I went back and reread Friedman and Schwartz. Actually, it's quite good to read, because what you get reminded of is what happens if you have an unstable world where money shifts between the commercial bank and the central bank world, and that was a characteristic of certainly the 19th century US system, and it was very unstable. But I think the question that I do have is, if we went down this road of limiting probably setting limits, as we have said we would, what exactly is the authority for that? I mean, it's an efficiency and a risk question, response. Get that. But what exactly is the authority to tell the public you can only have so much central bank money? It's a difficult. Stefan's nodding. I think it's a difficult question at root.
Yeah. It's a very difficult question.
Yeah.
It's the kind of question that you can have an intuitive answer to.
It's easy to say,
but then you really need to, really need to think through. On the Augustine, please.
Yeah, on the first question, I fully second what Andrew said. Let me add just two points. One, technology will not define if a currency is more coveted for others. I think the real issue is what gives value to the money and the usability. And I tend to agree with Andrew that if it's being fragmented and others, payment systems are being developed for the wrong reasons. We at the BIS are working on many of these projects, but none is designed for the BRICS. And as a matter of fact, we cannot directly support any project for the BRICS because we cannot operate with countries that are subject to sanctions. So I just want to be very clear about that. The question of Stefan, I think it's a great question. I fully agree. Now, for me, I think what we should ask from the parliaments is to preserve the options that today population has. And the option that today the population and society has is to be able to have a retail direct liability of the central bank. Today we have it in the form of cash. Now, why, given the technological development, we could not give access to society in the technological representation that society demands? Once you give that option to society, then it will be a matter of competition as it is today. Having in mind that there is commercial sector and there are others that really will be striving to become far more competitive than central bank money. But I think it's very important to give that options to society. Otherwise, I think the role of the central bank would put into question.
Fantastic. I think that's a perfect way to end this panel, and with ending this panel, end this 39th meeting, International Banking Seminar. Let me, I'll just conclude by noting, and this is not a summary, but a common theme. In the end, with money, with all the innovation, the central bank is at the core. Has to be at the core, and the linkage between various forms of money to have that finality of settlement, the speed of settlement, something that would be new, but this singularity, this singleness of money there. And the question is where to set the boundary as you move out towards the user. And one of the things, many things striking about the discussion, but this core point of being user-centric. Ultimately, it's about people using the money and how do we make that, and this potential that exists to be much more inclusive in a much broader sense. Not just individuals, but this point, you started with Shakanta, a broader range of transactions and exposure, and Andrew and others brought it up. So where does the boundary struck? And I'll just compliment the panel, because the commitment, not just the technical expertise of them and their institutions, but looking to find the way to set that boundary that allows for that competition and innovation to happen, so that the users get the users, the citizens, our colleagues around the world, get exactly what they deserve from the financial system. So if you join me in thanking the panel, and then join us for